they cross a line, but then,
Sure.
you know, they could potentially monetize that.
Can we finish on Walmart? Choiceful.
Yes.
What do you make of that word? The consumer's becoming more choiceful.
You know, I'm struck by one of my guests who said they like to play down some of the expectations. At what point Sam Stovall was talking about they're really good at managing expectations. How much is this basically just trying to do that versus a more cautious sentiment that we're seeing in the retail sales that we got last week?
We've heard the trade down story for quite a while, haven't we? That speaks to this consumer that's not doing too well. Compare and contrast that to the labour market figures, which have been pretty robust still. A string of better than expected economic data out of the labour market for the last 6 weeks or so.
Yeah, but I keep going back to psychology. When you go to the grocery store, even if you're making more money, you still find it disgusting that you have to pay 15, 20, 30% more than you did 2 years ago.
I'm not going to name the store. I'm not going to name the store. You won't get me to name the store.
Does it rhyme with Roll Roots?
No, this happened. No, it actually doesn't. This happened yesterday. A pack of cherries. I did not buy them. $20 for a pack of cherries.
Yeah.
Put them down and walked away.
But they would have been organic.
Absolutely. No, I don't care how organic they were. I really don't.
Okay. You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall? That's a great question.
I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Live from New York City, equities pulling back on the S&P by 0.25%. On the Nasdaq 100, down by around about a third. Last week, no real drama at all. Pulled back just a touch in the face of yields repricing higher once again. Let's check out the two-year. The two-year yields up double digits last week. Yields this morning down about 4 basis points or so. We are down to 459, Lisa, 93. On a 10-year, down to about 426.74.
And this really comes as people price out the chance of some sort of recession and take a look at inflation just keeping benchmark rates higher for longer. Key question for me is, do we fully understand the inflationary impulse if we're getting it wrong with both CPI and PPI at a time of not the greatest kind of strength, at least not from retail sales?
What do you think about the City line from Andrew Hollenhorst moments ago? He's been talking about this now for a while. Soft landings are unlikely precisely because inflation forces the Fed to hold rates higher for longer.
It works as long as you believe in the transmission mechanism, but one of the big challenges has been the long and variable lags. So I'm curious about when that sort of kicks in, and that I think is going to be a continued debate. Is it going to materially shrink the economy to have rates higher for a couple extra months? I don't know.
Let's turn to foreign exchange. The euro, 108.05. Euro just a little stronger. Last week, another week of dollar strength. The rest of the world is really struggling. China is struggling to find a floor in its property market to stimulate demand all over again. The UK is contracting. Germany is contracting. Japan is contracting. The United States right now, Lisa, is not.
And how long can that continue at a time when you are seeing signs of weakness, but ultimately people keep talking about the fiscal backdrop, that people are still getting money and that money is still getting pumped into different kinds of technological advancements and different kinds of energy sources? And at what point does that either fade out or really become the big distinguishing feature with the U.S.?
And that's the big difference right now between the United States and the rest of the world, particularly China. Under surveillance this morning, your top stories, the U.S. proposing a UN Security Council resolution warning Israel against an attack on the southern Gaza city of Rafah. According to a draft text seen by Bloomberg, the text warning a ground invasion would see further harm to civilians and have, quote, serious implications for regional peace and security. Rafah's population has quadrupled in recent months, with more than 1 million Palestinians, Anne-Marie, seeking refuge in the city.
This is notable because the U.S. has been reluctant to back any sort of ceasefire for the past 4 months at the UN. I would note one line in this draft text, though. Such a major ground offensive should not proceed under current circumstances. I think it gives some of that pressure on Netanyahu to make sure that if they were to go in for a ground invasion, they do protect these Palestinians. And more on this week, because Brett McGurk, President's top advisor, will be in the region.
Another visit, I think, to Egypt this time, right?
Yes.
Yeah, one to watch through the week. Here's one to watch this morning. Earnings from Home Depot, the latest from them. The stock is sliding this morning after reporting a 5th straight quarterly decline in revenue. The company's CEO calling 2023 a, quote, year of moderation. Walmart also reporting this morning, offering softer guidance for 2025 and agreeing to buy TV maker Vizio for $11.50 per share. The deal will help Walmart expand its advertising business called Walmart Connect. The whole company, Lisa, as you've indicated, starting to sound and look a whole lot more like Amazon week after week, month after month, year after year.
At what point is Walmart a tech company? And we're talking about the shipping, we're talking about the different kinds of data and
They'd
advertising.
love this conversation.
Well, I mean, they're hiring more tech people than anyone else. Isn't this kind of the push that they're making? I'm struck by the diversity and size is the dominant feature in the successful ones. Home Depot is more hinged to the home building market and the home buying market, and they're suffering. Walmart isn't hinged to anything because they own the world. So at that point, they can sort of capitalize on whichever lever is being pulled at the moment in the economy.
I think they'd love that multiple as well on the stock, wouldn't they?
Well, they would.
Yeah, just a little
They're
bit.
aiming for it.
Just a little bit. Speaking of size, the size of this one, Capital One, agreeing to buy Discover in a $35 billion all-stock deal that creates the largest U.S. credit card company by loan volume. The price representing a roughly 25% premium on Discover's last close. Capital One saying the deal will help build a payment network that can, quote, compete with the largest payments companies. The deal is expected to be completed by the end of this year or the beginning of 2025, pending shareholder and regulator approval. Anne-Marie, I think that was a dear regulator rationale for the deal, wasn't it?
Well, yes, Jonathan. When you look at what's going on in Washington, the FTC, the DOJ, 2021, they promised that they're going to look more carefully. They're going to be more aggressive when it comes to antitrust enforcement. So is there a potential that this deal doesn't end up going through because they're going to look at the credit card scope and say this is just too big a behemoth and it's going to ruin competition?
Without doubt, there is potential. It's all anyone's talking about this morning is can this deal close or not?
Yeah, but again, who is the competition for credit cards? Is it other credit card companies or is it a firm? I mean, at a certain point, if you have innovation, you just start to wonder whether the rationale just starts to be no, no, no. And then it raises this question, how much conviction can you have when there's a huge differential in antitrust policy between the two prospective presidents?
The antitrust policy issues, it's just open to interpretation all the time. And Lisa, I think that's the ultimate problem. If you do widen the scope, you broaden things out and start to take account of what's happening elsewhere with things like a firm, you get a different picture of things. If you sit there and just say, yeah, it's going to be bigger than Citi and JP Morgan and no one else competes, sure, you're going to end up with a very different picture of things.
This is the reason why Paul Taubman, when he was on just a couple of weeks ago, said that it's not going to be the M&A boom that so many people thought that it would be because of regulatory uncertainty. And this year is not going to be the year. Next year, maybe, when people have the certainty of what they're going to be dealing with. But right now, how do you really understand whether something's going to be stymied or not?
Particularly if there's a different person in the White House.
Exactly.
With a very different view on these kind of issues. Let's turn to the energy sector. A little bit of tension in the energy sector. Venezuelan President Nicolas Maduro threatening to bar ExxonMobil from expanding in Guyana. The oil giant is looking to grow development in the South American country's offshore reserves, expecting crude output to hit 1.2 million barrels a day by 2028. Venezuela has continued to make territorial claims about the region stretching back to colonial times. Joining us to discuss Exxon's big opportunity in the region is Liam Mallett, the president of ExxonMobil Upstream from the Guyana Energy Conference. Liam, wonderful to catch up with you, sir. I want to go back something like 10 years and start in late spring, I think May of 2015, when this discovery was first made by you and a team at Exxon. Liam, since then, can you give us some size and scope, just how big the opportunity is in this part of the world?
Yeah, Jonathan, thanks for the time and good morning to everyone. Firstly, I think, Jonathan, just a little bit of context, this energy concept, energy demand continuing to grow as the world's population grows and we continue to focus on lifting people out of poverty. And oil and gas, a fundamental component of that mix, and from our perspective, that will also continue to grow, but very importantly, at the same time as we continue to grow it, lower and lower the emissions intensity of that oil and gas. And nowhere, Jonathan, a greater example than right here in Guyana. This is a deep water. This is technology play at the extreme, out of 2,500 meters of water, and we've been extraordinarily successful in a very short time. You think about, today we're producing over 600,000 barrels a day. That's gone from 0 to 600,000 barrels in 4 years, and the average development time from when we discover a well to actually bringing it online and putting that oil in the market is less than 5 years. That's about half the industry average. So, this is a country that is blessed with fantastic rocks, the rocks that produce the oil, a great partnership, great supportive government policies. We're doing it with lower emissions. We're spreading the benefits across the country. It is the kind of success, the kind of opportunity that comes along pretty rarely in a lifetime.
Liam, do you expect this to become the top producing country for Exxon outside of the United States pretty soon?
Well, I mean, it's certainly, right now, it's in our top 3 deep water developments around the world. And, at the pace that we're continuing to grow, Jonathan, over the next couple of years, it'll be right up there with the Permian in terms of the actual magnitude of the production. So very competitive, very exciting, and importantly, doing it with leading emissions intensity.
There's a real question about some of these security concerns, given the fact that there have been some serious threats from Venezuela's Maduro, talking about your exploration of the region. What kind of discussions do you have with the United States to ensure that your contract really gets enforced and that you're able to produce the amount of oil that you would like?
Yeah, well, we're staying very focused. We've been very clear. We're staying very focused on executing our operations within our defined contract area. That's what we've been doing. That's what we intend to continue to do. And, as we talked about, this development has many years ahead of it, and we're not going anywhere. So, fundamentally, we're delivering and we're developing and we're continuing to spread the benefits to Guyana within our area of operations. The matter for discussion with the borders is really a government matter, of course. We take the necessary precautions from an operational perspective, to the extent we can. But fundamentally, our focus is on doing what we say we're going to do, doing that within our approved contract area, and continuing to do that.
And that's the reason why we're talking about this is because Venezuela's president was talking about barring you from exploring certain waters in particular that it was talking about near Guyana, right off the coast, that it claims as its own. Are you planning on exploring those areas? Is this a point of contention that you're talking to the State Department, or is that not in your purview and you can continue with the production that you have planned without that?
Yeah, those wells that got discussed are in our contract area, and we do plan on proceeding with them here in the coming years.
But are you concerned about Guyana's ability to defend itself? It's not just the rhetoric from Nicolas Maduro, it's the fact that we have seen in satellite imagery him building up his own military on the border.
You know, again, that's honestly a matter for the governments. Clearly, you know, given the nature of operations, we're informed as to the nature of those discussions. We've been pleased with the discussions. We're very supportive of Ghana's position that this should be resolved through the ICJ process, and we'll continue to stay engaged with them.
Liam, one thing that you mentioned earlier on in the conversation is the technology required to explore these deposits. Liam, I think that's really interesting because if you go back to, I think it was 2018, when the IMF basically came out and said the terms of the 2016 deal between Exxon and the government in Guyana was too favorable towards Exxon, that the royalty share wasn't favorable enough for the government. Do you think the current situation, actually to go back in time, say 4, 5, 6 years, the current situation justifies that existing agreement?
Absolutely. You know, this is a risk-reward business, and you know, this was a front. You said it yourself, Jonathan. This was less than 2015, 9 years ago. This was a frontier, deepest water in the world type proposition that only companies with our kind of technology capabilities, our financial capabilities, could take on, and the contract was appropriate for that risk. And as we've continued to explore, you know, we are successful in parts of the block. We are not successful in other parts of the block. So this remains a frontier area that is still very early in its exploration and its development stage. So this type of risk reward is very appropriate for the nature of what we're doing here in Guyana.
Liam, you've talked about developments like this helping countries like Guyana get out of poverty. Certain elements of the West, and you've seen this from policymaker after policymaker, government after government, want to phase out fossil fuels before Guyana and countries like Guyana have had the opportunity to develop the opportunity in front of them. Now, Liam, I just wonder your thoughts on that. And clearly, as an oil producer yourself, you're going to have to talk to your book a little bit. But, Liam, I do wonder what the government's been telling you about that. Do they have to do this quickly? Are they worried about how fast the timeline they've actually got to explore and develop this?
Yeah, I think it's the mixed question, Jonathan. Again, you know, you know, first of all, we are developing these resources with industry-leading emissions intensity. Secondly, you know, we will be providing natural gas here, I think, as you probably know, to supply domestic onshore power generation here in the next year or so. This will get up and running. That in itself will halve the electricity costs to the people of Guyana and comes with significantly lower emissions than the alternative, which is imported fuel oil. So there is a whole value chain expansion potential from low emissions offshore oil to bringing gas into the domestic market and beyond, feeding a much lower carbon future for this country and allowing the country to grow and expand and spread those benefits into society at large, using gas as a low emissions source of energy and potentially other, you know, alternative energies as the economy grows. But, you know, the whole ability to get started and grow significantly and take gas and fundamentally transform the economy in a lower carbon way is right in front of our eyes, and is something that the government of Guyana has been very clear about in their gas development plan.
Liam, we'll speak to President Ali a little bit later this morning. I think we catch up with him from that conference in about 45 minutes' time. Big question that we've been asking and trying to find out the ultimate answer to is when we can expect a final investment decision to proceed with a 6th offshore oil development in Guyana. Liam, how close are we to that decision now?
I will let you confirm this with President Ali, of course, but we're expecting to see that in the first quarter of this year.
Is that still the timeline?
Yes.
Okay. Liam, appreciate your input this morning. Thank you, sir. Liam Mannon there of ExxonMobil. We will catch up with President Ali a little bit later on this morning. Fascinating time, Bramo, for this particular country, with a big dispute with Venezuela underway. If you go all the way back to the original find back in 2015, massive opportunity in front of companies like ExxonMobil. And then you get the IMF a few years later coming out and saying that that deal that they struck with the government of Guyana was too favorable towards Exxon. And then you have situations like this, where Venezuela is effectively building up troops on the border with a country, may have a war take place, who knows, some kind of military action at some point this year, starts to justify why it becomes such a high-risk opportunity for the likes of Exxon.
Venezuela's leader specifically went after ExxonMobil and said, do not drill in these areas. You are not allowed to. So it raises a question, where's the red line, right? And what kind of responses are going to be from the United States military to protect their right based on this contract to keep drilling there?
Well, the U.S. administration, Biden administration, has come out with unwavering support for Guyana, but when Admiral Kirby was asked about this specifically, because these satellite images were circulated, he says that their assessment has been that it's a very small nature, size, and scale at the moment. But obviously, this is something that is a concern. It becomes even more concerning when you see that companies are out there drilling and actually want to expand their exploration and business.
The president of Guyana joining us in about 45 minutes' time. Up next on this program, regulators closing in on CRE risk.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that.
A conversation up next, live from New York. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Authorities could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, equities pulling back 1/3 on the S&P 500. Your bond market shaping up as follows. Yields just about unchanged on a 10-year, 427.33. On a 2-year, down 4 basis points to about 460. In foreign exchange, the euro just a touch stronger against the weaker dollar. Stronger dollar through much of last week. 108 on euro dollar right now. Under surveillance this morning, regulators closing in on CRE risk.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that. But I don't think it's anything out of the ordinary versus what would have happened if there was more concern within another sector.
It's the latest this morning. Fed Vice Chair for Supervision, Michael Barr, saying regulators are focusing in on commercial real estate loans, adding because of the heightened risk environment and heightened supervisory attention, the Fed has issued more supervisory findings and downgraded firm supervisory ratings at a higher rate in the past year, also known as doing their job. Amanda Lynham, head of macro credit research at BlackRock, has been doing hers as well. Good morning, Amanda.
Good morning.
It's good to see you. Is the regulator on top of this in a way that they weren't, say, last year on a different issue?
I think the whole market is focused on it, including a lot of market participants, and clearly the public commentary from Chair Powell, Secretary Yellen has suggested that. I think for us, what we're really watching is, does this flow through to the broader system? Our base case is that we don't believe that it does, but that does not mean that there's more price that valuations that can reset. I think we do see more scope for that. This is a longer term process.
How truly idiosyncratic is some of this? If you take New York real estate, for instance, there are some loans, some deals which require rents to go up on certain buildings. You can't put rents up. You've got a big problem because rates are staying high. Is it very unique to, say, a place like New York, or do you see this right across the country at the moment?
It's idiosyncratic across CRE asset classes in terms of the categories, and it's idiosyncratic within. So New York is a great example where roughly half of the multifamily rent stock is rent controlled or rent stabilized. And so that really does prevent a lot of the flow through of the higher costs that we're seeing in the CRE market. I think for us, the issue is there are areas like industrial, hotel, self-storage that are actually doing quite well. There are areas like office that are well telegraphed. I think there's probably some more price reset to come there. And then there's multifamily where it's really geographical dependent. There are some regions where there's been a lot of overbuilding. There are others where supply is more well absorbed. And so it is very idiosyncratic, just like it's idiosyncratic with banks' exposures. So we know that banks on the smaller end of the spectrum have more exposure. The key will be, is this an earnings event or a capital event for those banks? That's really key to watch. But as you know, the historical evidence shows us that this is a multi-year process to correct, and we expect that to remain the case this time.
There are going to be people who are listening to this who are going to be saying, we've heard about this for literally 2 years and nothing has really come to pass. I mean, there have been a couple of pitfalls, but it hasn't caused systemic risk. It hasn't caused small banks to cause some sort of wholesale failure. How do you place this in terms of your understanding of risk? Is this going to contract lending? Is this a priced-in known risk? Or is this an opportunity where you're starting to see pockets where you can buy?
Sure, great question, Lisa. So two things. One is we haven't, outside of the idiosyncratic situations that have grabbed the headlines, we haven't seen major disruption, but we have seen loss reserves tick up. So large cap U.S. banks, for example, have reserved around 10% for realized losses in their portfolio. So that's a fairly draconian assumption. That would mean, just for example, a 20% default with a 50% recovery. So you have seen in the background office reserves tick up to around that 10% level. Overall, CRE reserves are in the kind of the low to mid single digits. So that is a good thing happening in the background. I would say on the lending side, bank lending remains tight, but it's easing, so it's not getting worse. So it's tightening at a more moderate pace. But CRE was the one area where the Senior Loan Officer Opinion Survey called out as, in addition to auto and credit card loans, as expecting to kind of remain tight over time. So I do think that it is more challenging given the higher cost of capital environment in general for kind of interest-sensitive asset classes like this. But then you also have the structural advantages. Is there opportunity? Sure. I think at some point I would say there are investors probably in this space who argue there's opportunity now. We believe that there's probably some additional price correction to take place.
You said something really fascinating in your recent research where you said the key for corporate credit investors, just shifting gears a little bit, is the Fed's willingness to eventually cut rates proactively in response to improving inflation as opposed to potential weakness. This is the reason why we're talking here about risks and people are covering their ears and saying, la, 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 UBS strategists raising their S&P forecast. Everyone's sort of bullish because ultimately this is the end of the hiking cycle, the end of the peak, this is peak rates, and we're talking about proactive cuts. How far does that get you to bullishness within credit that has already rallied?
So it's a great point. I'm not sure that 75 basis points will make or break any of these companies in terms of additional kind of financial flexibility. But what it does mean is that there's more clarity on the macro backdrop. And I think the fact that we're hopefully not getting any more hikes is probably what's critical for risk sentiment. The yield backdrop has been really important for corporate credit investors. And so a lot of investors that we speak to think that spreads are optically too tight. I would say the first first observation is we've been tighter than this as recently as mid-2021 when yields were much lower. And then secondly, it gets exactly the point you raised. It's a combination of a few things for risk. It's the Fed's signaling at the December FOMC that they're willing to cut proactively. It's lower quality borrowers' ability to tap the market, which we've discussed is a very positive signal in our view. And it's increased optimism on the soft landing. And so I think the combination of three of those things has actually boosted risk sentiment to a large degree, coupled with the fact that you can deploy capital at really attractive all-in yields. So I actually think we are often asked kind of, is the risk to spreads tighter or wider? I actually think it can be tighter. I wouldn't necessarily say that I would be surprised if we saw a little bit of widening from here. I would believe that that would be a healthy correction, but I don't think it's out of the realm of possibilities that spreads could actually move tighter from here because that yield-based demand has brought out.
Should we talk about M&A as well?
Yes.
And how we're financing that M&A?
Right.
You've mentioned this before. Yes. Keep hearing all stock deals, all stock deals. We don't hear debt finance, debt finance. How important is that, just as a change?
Really important for credit investors in aggregate. And I should say that the funding mix, so whether it's equity or cash/debt, has shown variation over time. Part of that is a function of the interest costs. Part of it is a function of companies actually managing their capital structures. What we've seen this year is that it's been a pretty benign skew for bondholders, so a fair amount of equity or cash and equity funded deals, but it hasn't been entirely the case. Pharmaceuticals, for example, have been acquisition sectors that have had a lot of cash funded deals ultimately replaced with debt. So it does matter to track the aggregate in terms of risk sentiment, but it also matters at the sector and idiosyncratic level. But in general, M&A is not always a bad thing for credit investors, I would say.
Always great to catch up with you. Thanks for being with us. Amanda Lynham there of BlackRock. Bramo, I think the first thing you thought of over the weekend when this deal between Discover and Capital One was coming together.
Yeah, basically all stock. What do you think? Of course, no debt, right? I mean, Walmart's deal with Vizio may be debt, but maybe just all cash. But I think that Amanda's point there about it's not bad for credit investors is understating the fact, because if you look at certain companies, people are buying the debt because they think they're going to be taken out, and that basically they're just getting an option on that to get basically at par after buying it at a huge discount.
Acquisitions that benefit credit holders and maybe not
stock investors. Yeah, this is a total shift. Reversal of what we saw for so many years.
Not the ultimate objective, of course, but yeah, maybe the consequence. Coming up on this program, Peter Chair of Academy Securities, Ed Mills of Raymond James, and the President of Guyana, Irfan Ali. You're watching Bloomberg Surveillance, live from New York. This is Bloomberg.
Cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port destinations. Functional. Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to do?
How about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Truth be told, the economic data is still pretty strong. It's softening, but it's not weak.
Because the economy is slowing, but it's not recessionary. But I think that there's some real stress under the hood of the system.
The confluence of data are all telling you this economy has more resilience.
Whenever we see something that's really surprising, take a deep breath, see what happens the following month, and don't dive into a premature conclusion.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Take a deep breath. Exhale. Relax. Was that therapy?
I think so.
From Ian Shepperson at Pantheon.
It basically has felt like therapy forever. Stop it with the cash, put it into risk, feel good, take a breath, it's all good.
NVIDIA will keep on rallying. That's what we've been told. That's what's been happening. That's not a judgment or a call about the next couple of days, okay? From New York City this morning, good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Equity futures on the S&P negative by 1/3%. Let's frame the week for you. Fed minutes about 24 hours away. You'll get some jobless claims on Thursday. A mini Fed meeting. You'll hear from speakers Jefferson, Bowman, Harker, Cook, Kashkari, and Waller. And then the big one, Bramo, NVIDIA, after the close Wednesday.
I was about to say, none of that matters. It all is NVIDIA. And basically, this week is very much earnings front and center. What more can we hear from Fed officials that they haven't already said that's really going to change the needle? Right now, this is very much, can AI keep on AIing? Can we get the sense that NVIDIA is going to rule the world? And at what point can they keep beating, or is this going to dent sentiment?
How many times have they beaten now by double digits and then raised? Well, and then we're sort of like the bar's getting higher. They keep on rallying by another 50%, and they beat double digits, and then they raise.
Which is a reason why I think a lot of people are expecting maybe we could get something different. And if that we do get something different, what does that do to sentiment? At a certain point, the hardware story has to shift to a software story. Right now, it's not. They're the hardware story. Everyone wants to hoard chips. At a certain point, you have to think people have the chips they need. Now they're going to start to use them.
NVIDIA up by more than 40% year to date. The big winner again on the S&P 500. The broader price action looks like this on the S&P. We're pulling back by 1/3%. In the bond market, yields shaping up as follows on a 10-year Treasury yield at the moment. Yields look like this. We are going absolutely nowhere at 427.33. In foreign exchange, 108 flat on euro dollar. The euro stronger by 0.2%. Coming up this hour, Peter Cheer of Academy Securities on downside risk in the market, Ed Mills of Raymond James weighing in on Biden's latest push for Ukraine aid, and Guyana President Irfan Ali on his push to make the country an energy powerhouse. That is a must-watch conversation a little bit later this hour. We begin with our top story, dialing back rate cut bets after hotter than expected inflation data. Peter Cheer of Academy Securities seeing more downside risk than upside potential, writing this. The market is skewed heavily towards being bullish. Within that, it's extremely bullish on a subset of names. Between positioning and price action, the risk of the next 5% move being to the downside is much higher than the probability that we will go another 5% higher from here. Peter, I'm pleased to say, joins us right now. Pete, good morning to you.
Good morning.
Fed minutes or NVIDIA? What matters more this week?
I think NVIDIA is going to be the key thing, though I think Fed minutes is just going to be used as another tool to reinforce expect fewer hikes or cuts and expect them to be spread out further in time.
We've been pushing out these cuts off the back of hotter CPI, hotter PPI. If you look at the economic mix over the last week or so, we've been doing it for the wrong reasons, haven't we?
Yeah, it's kind of strange how this has all been working. And, a month ago when we were at 7 cuts, I was at 4 thinking I was being a little bit conservative. Now I'm at 4 thinking, ooh, maybe I've got too many cuts priced in. And I think CPI is coming back, PPI is coming back. And to me, it's all going to hinge as the job numbers. Have they been true or not true? There are a lot of questions about the job numbers. If we really are seeing growth in the job market, these things make sense. If not, it's going to be sketchy and we'll start talking about recession again.
I was so excited to speak with you because you're a breath of fresh air after everyone's just saying, we're bullish, we're more bullish, we're even more bullish, and any potential dip is going to be a buying opportunity. You see more downside than upside potential right now, but is that only going to be a buying opportunity, or do you feel that there is something materially different that's coming down the pike?
I think what we're going to see is kind of this cascading where people try and buy the dip, it fails and gets pushed lower. So I think we get this fairly dramatic in a couple-day period, maybe a 5 to 10% pullback. And what I was watching closely last week, when we even had those down days, what I saw was a lot of option buying. There was a little bit of option selling, puts buying, but most of it was skewed towards calls. So I think people had that buy the dip. It was rewarded. But as you started fading Friday, I think people have committed almost all their cash, heavily dependent on NVIDIA. If something goes wrong there, I just feel this cascading sell-off, and you could get the zero-day expiration options kicking in a negative way.
So what does it mean for NVIDIA to disappoint? Does it mean just beat a little? I mean, how big of a disappointment does it have to be to shift the entire narrative of a market?
That is very hard to tell, but I don't understand the company well enough to understand individual stocks, but I will say that whatever the earnings estimates are, expectations, I think, are way higher than that. So I think people are expecting a very, very good beat. And even if they beat, I just wonder who's turning around to buy. It could be one of those cases you get good numbers, it bounces right after the numbers, then everyone looks around, who's the buyer? Turns out no one's a buyer.
So we've seen upgrade after upgrade in terms of S&P 500 forecast, and it's come despite some of the higher yields that we've seen on the heels of fewer rate cuts getting baked into the market. There's a feeling that whether it's the AI boom or whether it's just the sense that we're at the early cycle, it's going to broaden out. Do you push back against that? Do you see something else that's going to kind of drive the cuts that's different than what's going to potentially be the reality right now?
So I thought retail sales was particularly interesting, right? The retail sales had kind of confused me, why they were so good. We had some views that they were being pulled forward because sales were great in November, December. Brands that don't normally go on sale had pretty widespread sales. So all of a sudden you had this miss. And we track closely some of the credit card data. It's now well above trend. So remember post-COVID, everyone paid down their credit card, and it was rising quickly, but we are still well below long-term trends. We're above that. You're starting to see delinquencies rise. They're not at alarming levels. So if the consumer starts to roll over, then I think we go back to talking about recession and fears that. So to me, it's the jobs, consumer. That's what I think we're missing. And everyone's maybe being a little bit too optimistic on the other things, and those aren't getting the attention they deserve.
I'm listening to the words that you're using when you discuss the data. True or not true? Sketchy. What are you suggesting is happening here?
I think we live in this era. You can pick up your phone and know exactly where you're going to go. Everything's instant. And I think a lot of our data collection is old school. We're not sure how we do it. We do these surveys. Who knows what good data we're doing? And then they're trying to apply these analytics to the data, right, to do the seasonal adjustments. Who knows that their data is any better than ours, how they're analyzing it? So I'm just highly suspect. I would love to see a big spending program out of DC to revamp how we collect data so that people can make really good decisions based on accurate data in this world where everything is instant except our government data.
In the meantime, what's the lodestar then? Given the fact that a lot of people have raised this, and before all the conspiracy theorists start saying, yeah, everything is manipulated, it's more that people aren't picking up their phones and they don't have landlines, so the number of people who are called is sort of a not representative sample.
And you look at the Fed in terms of the jobs data, I think the survey response on the establishment is very, very low for the initial. It gets up to about 95% response by the time they do their adjustment 2 months later. But what good is that initial number when you're getting these incredibly low response rates? So I think we need to figure out a way to collect data better, more timely. And seasonality, I think, is tough to deal with at any time, but we've gone through 2008, we went through the European debt crisis, we've gone through COVID. It's a mess in terms of seasonality, so I think those adjustments are tricky too.
John was talking about Andrew Hollenhorst's note earlier this morning about how the reason why there isn't going to be the soft landing is because the Fed's going to have to hold rates as high as they are for as long as they are. Do you believe that there is going to be a more dramatic tightening that we experience in the next couple of months?
one of my beliefs when I thought we'd have 3 cuts this year, May, June, July, 25, 50, 25. I'm probably going to dial back on that. But part of my thesis was the Fed is not going to want to cut in September or November because it will look like an election manipulation issue, or someone will be called out by Trump as such if he's the side. So I think they're going to have to be very cautious about what they do in and around the election so they're not in any way portrayed as affecting the election outcome. So if you take September, November off the table, yeah, maybe you only get 1 or 2 cuts and that's it.
Do you think that weighs on them? You think it actually weighs on Fed officials?
I don't think that they want it to, but I think it's going to be very difficult in this day and age where, many more people are talking about monetary policy than I remember certainly 8 years ago.
Yeah.
Social media makes it easier, and everything now seems to divide very quickly into 25% hate it, 25% love it, and 50% are maybe agnostic, but you get instant hate or love. So I think it could become just horrible for them to have to deal with. I don't think they want to deal with it, but sometimes you got to be cautious.
Should we talk about something that's horrible to deal with and no one wants to deal with it? The deficit. You think this is going to take on greater importance as the year progresses. Why do you think that returns as the issue?
Well, one, you start seeing articles about it again, too. So everyone quieted down about that. And when this was coming out, and we got very bullish at 5% on 10s towards 4%, part of it was people were jumping ahead and talking about supply like it was going on forever. They were talking about, oh, the average coupons rise. All those things take time. Now it's 6, 8 months later, the supply is still rising. The average coupon is slowly ticking up. I think that's going to come back to the forefront, and I think the election's really going to spur that because my estimation is you're going to, one side say, well, we're going to do massive tax cuts, but that's not going to affect the deficit. The other side's going to say, we're going to do massive spending, but that's not going to affect the deficit. And the markets are going to start realizing this deficit's going higher. And the other part of this, we are all worried about foreign buying. China's not buying. China's continuing to slow down. And as China has to defend their own markets, their use of treasuries is not going to be to buy more. It's going to be dwindle that to help their own economy.
AMH, no one wants to fix it.
Well, if you fix it, you have to talk about entitlements. And that is the third rail of politics. And no one is going to try to campaign on, I'm going to cut Social Security and Medicare.
How's that going for Nikki Haley?
I mean, she's talking about it.
Whispered it a few months ago and then kind of whispers it even more quietly now.
With us, she said that 65 was way, way too young. And then she wouldn't say that number again because she's already getting hit on it. She's talking about it, but she's not going to be the nominee. And the issue is no one in Washington wants to talk about this because it means serious cuts to entitlements or a reestablishment of how these programs work.
Good policy, good politics, Bramo. Two very different things.
You're just trying to wind me up. I know.
Just a little bit.
Just, I mean,
just
honestly,
trying to get you going.
My thing that Peter just said is that everyone's going to realize that the deficit is only going higher. We realize it now. Here's the thing. It's not like this is sort of an unknown. It just sort of, you put a spotlight on it and suddenly people worry about the auctions again.
And one thing that I think will be easy for people to point to is as interest expense becomes a bigger line item, that's going to stick out very starkly. And that's something no one can defend.
And Chair Powell said on 60 Minutes, it's urgent. He normally wants to stay very far away from fiscal issues, but he said, yeah, I would characterize it as urgent matter.
Peter Chair, you'll be sticking with us someplace to say. Let's get you an update on stories elsewhere this morning. We can do that with Bloomberg's Danny Berger. Hey, Danny.
Hey, John. California is still grappling with extreme weather in another atmospheric river. The National Weather Service warns of difficult conditions through Wednesday after an expected lull today. LA and San Diego are at risk for significant flooding. 5 inches of rain is predicted for some areas. The storm is expected to pass through quicker than the one earlier this month. Shares of Home Depot are lower in the pre-market trade. The company posted a 5th consecutive quarter of revenue declines. The company saw fourth quarter comp sales lower by 3.5%. High mortgage rates and a slowdown in construction underscored the demand for home improvement. In a statement, CEO Ted Decker said, quote, 2023 was a year of moderation. Capital One has agreed to buy Discover Financial. It would rank as the biggest global deal of the year. It's a $35 billion all-stock agreement, and it would create the largest U.S. credit company by volume. Capital One will be paying a 26.6% premium to Discover's close on Friday. The deal is expected to complete by the end of this year or the beginning of next, pending shareholder and regulatory approval. That's your Bloomberg Brief. John.
Danny, thank you. Coming up on this program, up next, the White House intensifying efforts to secure aid for Ukraine.
I think there's plenty of path for Ukraine aid to get passed in Congress. 3/4 of the House is in favor of Ukraine aid. It is much more likely than not that this happens.
That conversation coming up next, live from New York. This is Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Mic up? There it is. 1, 2, 3, Magic TV. Under surveillance this morning, the House intensifying efforts to secure aid for Ukraine.
I think there's plenty of path for Ukraine aid to get passed in Congress. 3/4 of the House is in favor of Ukraine aid. It is much more likely than not that this happens. There are a variety of processes to make it happen, from a discharge petition to a suspension calendar to even regular order. But I do think it's likely.
Here's the latest this morning. President Biden saying he's willing to meet with House Speaker Mike Johnson in order to pass the $95 billion foreign aid package. Pressure building to pass aid for Ukraine following the death of Russian opposition leader Alexei Navalny. Ed Mills, Washington policy analyst at Raymond James, joins us now with a long list of things to get through. Ed, before we get to foreign aid, I want to talk about the prospect of a big deal between Capital One and Discover. From your perspective, Ed, and you're perfectly positioned to talk us through this, how likely is it that this administration gives that deal the green light?
So, John, what's fascinating about this is that we've been in conversations with lots of contacts here in D.C., and they told us about the top deal that could get done is about $100 billion in assets. Now, Discover's 140, Cap One's about 500, so much greater. The reason why they've been telling us that is A, the bank panic of last March, but also OCC, which is the primary regulator of Capital One, has just put out new kind of guidance on regulations and asking for kind of comment. The Department of Justice is asking for comment on what they want to do with bank mergers. And so I think trying to get this done by the end of the year or early next year, unless President Trump is reelected to a second term, this is going to be very difficult from a regulatory perspective to get done in that time period from where I sit.
Well, is it this new rules that they're trying to finalize the issue, or is the U.S. election a potential issue that could drag down this deal?
Yeah, Anne-Marie, it's really interesting because Basel III Endgame, which is what the Fed is calling their new capital rules, do have kind of higher standards for banks above $100 billion, driving some of that consolidation. We've said, if you go through with this, what you're going to see is more bank consolidation, because the closer you are to the lower end of that spectrum, the more costly it's going to be and the more likely you're going to need to have that consolidation. There's a couple of things in there. If you have a credit card network, higher capital charges. If you have a lot of credit cards, as a general rule, higher capital charges. I think those probably have to get changed in the final rule, but that could be driving this conversation. What's really fascinating is what could also be driving this conversation is on the Hill, there's been a push to say for credit card issuers, if you are above $100 billion in assets, you have to use a network that's not Visa or MasterCard. Discover was looked as the winner there. Now, that bill has low odds, but it could be part of a pro-competition angle that they would say, we're not really a bank, we're a credit card company with this network, and that's why you should get us approved. So that's going to be the push and pull this year, is how much we look at it as a network versus how much we look at it as a bank.
Ed, can we talk about a little about the timeline when Congress gets back? They have 2 to 3 days to fund the government, the first tranche that needs to be funded on March 8th. Do they get this done? Do we see a CR, or is there higher risk of a government shutdown?
Yeah, Anne-Marie, I think the honest answer is I don't know. You're right. We have the House and Senate out this week. The House and Senate come back next week, but the House only comes back next Wednesday, 3 days before that March 1st deadline. We've had members of the House leadership say there's not going to be another CR. So it's really hard to see how you're going to be able to get the finalization of those 4 appropriations bills with deadlines on March 1st. Is it possible? Yeah. Or could we also see a partial government shutdown, building up that crisis moment, trying to get something done before March 7th, which is the State of the Union address, or March 8th, when the other 8 bills and bills that have a bigger impact on the economy and on government, quite frankly, the Defense Department, Health and Human Services, that's when those bills are done. So I think that we're not going to have a prolonged shutdown if we're there, but could we have a building up of a crisis leading up to those 2 other events that are really important in DC? Yeah, it's totally possible.
So put that to one side. That's just funding the normal government. What about the foreign aid bill? This has been a stalemate in Congress. President Biden said he's willing to meet with Speaker Johnson. Does that show fresh impetus to get this over the finish line?
Yeah, so Speaker Johnson asking for that meeting with Biden, the homicide of Navalny, the kind of concern about Russia in them putting a nuclear weapon into space. All of this is building up pressure. What I normally am looking for is that when you know you're going to get jammed, and I do think Republicans in the House are going to have at least have a vote on this, and if there is a vote, it passes, you're usually looking to see what else could I get done. Now, the House last week before they left, they voted to overturn President Biden's LNG kind of ban for the next couple of years with the new studies. I would normally be saying, all right, let's get that added. Let's get a border bill in. The problem for Speaker Johnson is that the more he's seen as negotiating this, the more his speakership is in doubt. And so he'll probably have that meeting. But I think ultimately where this gets done is through some sort of parliamentary pressure that a vote happens maybe against his will through a discharge petition, through defeating a rule and kind of moving to a previous question with this bill alone. So I think it gets done. It's just a question right now. The politics has to play itself out before we figure out what is that mechanism. But I do think by mid-March, we will have this aid package signed into law.
Just taking a step back, Ed, it seems like from a market's perspective, there are 3 buckets in D.C. There's the regulatory uncertainty, which we see with mergers and acquisitions. There's a deficit, which we were just talking about with Peter Scheer, and how much it's increasing as we continue to finance a whole host of issues. And then there are geopolitical risks. Which of those 3 do clients ask you most about or most relevant to their investment thesis?
Yeah, Lisa, it really depends upon the client. So we have a large private client group, and when I go and present at Raymond James to those groups, we talk about all of it. When I'm talking to a portfolio manager that's global, geopolitical risks come in. When I am in Europe, more of that debt and deficit conversation comes into play, partly because if you want to be part of the EU, there's caps on the debt and deficit. But when I'm sitting and talking to a bank investor, which I'm going to spend the rest of the day talking to bank investors about this Cap 1 Discover deal, they want to know about regulatory risk. They want to drill down into Basel III Endgame, the CFPB's credit card late fee rule. So I think for me, it just makes for a really interesting job and lots of conversations to have. DC is probably at its max right now, and it's probably only going to get more interesting as we get through 2024.
Looking forward to these regular conversations, Ed, about these issues. Ed, thank you, sir. Ed Mills there of Raymond James. Peter Scheer of Academy Securities with us around the table. Pete, let's talk about what's happening on the international stage at the moment. Clearly some tension in the Middle East, some tension continues in Ukraine between Russia, Ukraine, and arguably the rest of the world. You have a more constructive view on the end game to this going through 2024. Where does this one end up?
Yeah, so we look at it, we have 18 retired generals and admirals who serve as our geopolitical advisory group at Academy Security, so I tie a lot of this into it. So to be quick, I think in the Middle East, we're watching very closely for anything that forces us to acknowledge Iran's actions and start clamping down on their oil sales. They're selling about 3.5 million barrels of oil per day, mostly to China and India. That's helping lower global oil prices. We've turned a blind eye to that. It's well above the sanction levels. So anything that forces that, I think, could be, on a tactical level, very bad for markets. You'd see oil spike. You'd see a lot of concerns. When we look at Russia and Ukraine, we see this drifting towards some sort of truce or peace, whether it's before or after the election is tricky. I think it's going to depend a little bit. If it looks like it's a close election, both sides may want to say, let's not take what happens in the election, let's come to some sort of truce. I think the big bargaining chip that people aren't talking about very much is we held back a lot of Russia's dollar reserves. That will probably be a big bargaining chip in terms of Ukraine, you take $2 trillion, Russia, you give $2 trillion, we all go away. So that's kind of where we're leaning. I think it's actually going to be very inflationary, though, for Europe if we get that. I think that's the opposite.
Well, do you think that just generally, that all of these types of geopolitical risks become inflationary because people are going to be spending more on military, people are going to be spending more and more generally, and you have potential commodity risk? Is that part of why you're more negative?
Yeah, and also, if you do get rebuilding in Ukraine, you're going to have an immense amount of commodities used to do that. You're going to have to hire people. You're going to have to convince people to move back to Ukraine, so that's there. And in China, our big view, or my big view, has really been that we're in this shift from made in China to made by China, where China's going to go from manufacturing our brands to trying to sell their brands globally. A year ago, people looked at us like, that seems insane, and now you're watching the progress BYD, some of their phone companies are making.
You see it everywhere.
And I think they're going to go aggressively after the emerging markets, and then maybe into Southern Europe as kind of the weak points where they need those, discounts. And so I think that's going to be the big shock to the system is China goes from being this kind of manufacturing hub of our products to trying to manufacture and sell their own. And that we're not prepared for. And I got a big boost when Elon Musk was clearly worried about something like that.
Yeah, governments might have other ideas. We'll see how that works out. Peter, thank you, sir. It's good to see you. Peter Cheer of Academy Securities, BYD, Latin America, BYD, to Peter's point, Italy and elsewhere.
And this means that they're not going to necessarily be producing things cheaply for companies that are in the U.S. or in Europe, and that means inflation, and that means potentially some real questions about tariffs.
Up next on this program, don't miss this, the president of Guyana, Irfan Ali, joined us from the Guyana Energy Conference on his nation's big opportunity in the energy sector.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
live from New York City, about 60 minutes out from the opening bell. Equity futures negative here, 0.4% on the S&P and on the Nasdaq 100 too. In the bond market, yields shaping up as follows. 2-year, 10-year, 30-year look a little something like this. Your 10-year yield is unchanged at 428.12. The 2-year down 3 or 4 basis points to 460.57. I'll get to foreign exchange, then we'll turn to energy. And FX right now, the euro looks a little something like this. Euro dollar 108.08, positive there by about 1/3%. Turning to energy, Guyana is calling for the immediate development of its gas resources to make the country a regional energy powerhouse. Exxon, which discovered oil in the country back in 2015, is ramping up production fast and aims to produce 1.2 million barrels a day by 2028. Venezuelan leader Nicolás Maduro may have other ideas as tensions continue to rise over a border dispute stretching back decades. The president of Guyana, Irfan Ali, joins us now from the Guyana Energy Conference and Supply Chain Expo. Mr. President, thank you for being with us, sir. Let's talk about that tension first of all. You've indicated over the last few months that Venezuela has been building up a military presence near your border. Maduro has not denied that claim. Maduro and the Venezuelan government have issued a warning to Exxon about developing this opportunity in this particular region. What kind of assurances are you offering to foreign companies operating in your country?
Well, the greatest assurance that we can offer is that Guyana is sure of its territorial integrity. We are sure of our borders. And in 1899, our borders were settled. Venezuela participated in the settlement of those borders. So there is absolutely no doubt as to where our borders are. A controversy was raised by Venezuela decades upon decades after, when we were going to independence, and that controversy is before the ICJ. We are a country that respects the rule of law. We are a country that abides by international law, and that is why we respectfully ask Venezuela to participate and be a member, a responsible member of the international community, and to respect the outcome of the ICJ. But we don't, we are very sure of our case. We are very sure of our borders, and investors need not to worry because their investment are clearly in the territorial space of Guyana.
I'm sure they have their own worries, sir, and they can talk for themselves. I'm wondering from your perspective how closely you're working with the US State Department and what kind of assistance they've already offered so far to you.
So we are working with not only the US State Department, we're working with many of our regional and international partners. For a matter of fact, in the region itself, CARICOM has reiterated its support for Guyana, its respect for Guyana's territorial integrity, and also called upon Venezuela to participate in the ICJ process and to respect the outcome of that process. So too does our neighbor Brazil, France, Canada, the UK, the US. Most of the international community has and is in support of Guyana, knowing the fundamental facts and the truth, and that is our borders were settled in the 1899 arbitral award.
Experts say that the imbalance for the military between Venezuela and Guyana is 100-1. Yes, you're talking to your partners, but are you going to be building up your own defense capabilities?
So we are doing a few things. One, we're investing in the modernization of our military, in the advancement and use of technology, in the building up of our human capacity, our infrastructure. But more importantly, we're working closely with our allies. We're working closely with the US, with France, with the UK. We have many training exercises that we're conducting together. We are working with the regional security system. So it is not only what exists within the country, it is also our work that we're doing in the international community and our partnership with our allies and friends.
The U.S. has said that this assessment of this military movement that Maduro has on the border is very small in nature, size, scale, and scope. Do you agree with that assessment?
Look, we believe that any threat of our territorial integrity, any threat on our borders must be taken seriously, and that is what we're doing. We're taking this very seriously. We are working with Venezuela now and through CARICOM to ensure that this does not escalate, because our primary focus is to ensure the region remains stable and the region remains peaceful. That is our primary focus. Our primary focus is to ensure we do everything to promote that stability and peace within the region. But in our assessment, there's a lot of assessment on Venezuela and their capacity and capability and what is driving this claim. But for us, it is a threat, and we're taking it seriously, and we're ensuring that we do everything to secure and protect the territorial space of Guyana.
Mr. President, how important is it? How much urgency do you feel to monetize the oil and gas reserves in Guyana now before there is some sort of significant transition away from fossil fuels?
Well, I think bar the transition, because we have to look at transition too. We still have 36% of the world's energy coming from coal. We still have tens of millions of people around the world who are living in energy poverty. The technology on transitional energy source is still not there to give us competitive transition. The capital cost of the transition is enormous. Developing countries are having great difficulties. The supply chain of the technology required for transition is still not at capacity. So there are a lot of challenges on the transition side itself. And we are all for the transition. We are all for cleaner energy, greater use of renewable. But that I just want to make that point, that the transition timetable has challenges by itself. Notwithstanding that, we understand that we must, in an expeditious, safe, and sustainable way, also develop our oil and gas resources. So I think that the time to develop is now, the time to advance our production is now, the time to monetize is now, and that is why we are working aggressively on moving from discovery to operation, but also importantly, moving now in an aggressive way to develop the gas resources of Guyana and to integrate the gas resources into our other sectors so that our other sectors become competitive, and using the gas resource as a tool to build out the infrastructure, capability and capacity of the country, into connecting the country more integrally with Brazil, because once we develop the gas resources, it opens up the opportunity of justifying the deepwater port in Guyana that can serve all of northern Brazil, and building out that infrastructure to link northern Brazil to the Atlantic through Guyana. That will save many days in shipping time, make northern Brazil more competitive, reduce their shipping costs, improve their infrastructure link, and advance their competitiveness. That also allows us now, that natural gas allows us now to move to value, upping the value chain for our bauxite, which is a natural resource, because we can now use cheaper energy to develop an aluminium plant with 1.5 billion tons of bauxite reserve between Suriname and Guyana that can now be transitioned into aluminium and a higher value market. That also helped to justify the building out of a deepwater port and the integration of the infrastructure. So this is how we're thinking about it, not just the expeditious monetization of the gas, but how we will use that gas to build out and widen the economic base and bring in new opportunities for the country and the region.
Mr. President, when you talk about urgency, is there still the timeline that we heard from Exxon, first quarter, to approve their sixth deal with respect to oil?
Well, we are examining that right now. The technical people are looking at it. So that is a technical assessment that is being done, and we are working to move it rapidly as possible, but also ensuring that it meets all the conditions and satisfy all the requirements.
You're going to be one of the foremost players potentially in this sector in 2030, something that is new for your country. How concerned are you about inflation rising within Guyana?
Well, we are working on ensuring that the economy is not dependent on oil and gas, but the resources from oil and gas is used to build out the other segments of the economy, making us more competitive. What we want to do is to position Guyana as a global leader in 3 areas. energy security because of what is available to us and the role we can play in the region. Food security because we have competitive advantage in the production of food, arable land, huge reserve of fresh water. So we want to be the leading producer of food in the region. And thirdly, on climate, we want to be a leader on climate because we're already providing global leadership on the forest. We have the lowest deforestation rate in the world. We have a forest the size of England and Scotland combined that stores 19.5 gigatons of carbon. We already have most of the forest at jurisdictional scale carbon certified, ready for sale on the voluntary market. So those are the three things that we're pushing aggressively, building out our human resource capacity. And all of this help in taming inflation and ensuring also that we invest wisely. We don't drive the economy into overheating the economy. We don't build beyond what is required for the development and advancement of our country, that we have strong fiscal policies, that the resources coming out of oil revenue goes directly to invest in areas that will grow the country, strengthen our human resource base, and support the socio-economic development of the country, and also save for the future. So these are the things that we're doing. So we're not concerned. If you look at our inflation rate in the last three years, you will see that it has been very stable, the lowest in the region.
Just want to finish, Mr. President, on incentives for foreign companies to develop these natural resources. Quite clearly, this is still considered a high-risk investment for many companies that have the technology that you require, including the likes of Exxon. You'll remember a number of years ago, I believe back in 2018, the IMF criticized the terms of the deal originally signed back in 2016 as being too favorable towards Exxon, that the royalties being offered to your country were not high enough. I just wonder, going forward from here, given the situation with Venezuela, how difficult it's going to be to demand higher royalties from some of these companies.
So we have already said that the agreement with Exxon and the Stabroek block, yes, we have said this, that it was highly slanted to Exxon. We have already changed the PSA. So the PSA, the new PSAs will be far different from the one Exxon would have benefited from in Stabroek block. We have made this public. So the PSA is striking a balance because, as you rightfully said, this is an industry also that has its own difficulties. Raising capital for exploration, the cost of is difficult. The cost of that capital for investment in oil and gas sector is higher. It's not only limited, but the cost of that capital is higher, which is driving up the cost of operation, which is driving up the cost of exploration. So all of these are difficulties that the industry is facing and will continue to face. So we have to ensure that we have a PSA that strikes the balance, that gives the country, give us the best returns, but at the same time does not work in a way that drive away investment. So in the recent auction that we had a PSA that was shared among all those who participated in the auction, and that also we are continuously looking at, not on the fiscal side, but more on the conditionalities and guidelines. So you're correct. The future PSAs will be far different from that Exxon got on the Stabroek block, but that difference would not be to the detriment of investors.
It's a difficult balance to strike, I'm sure. Mr. President, thanks for being with us today. President Irfan Ali there of Guyana, on the opportunities and the risks still ahead for that country to develop what is a massive opportunity in natural resources.
Absolutely. It would change the landscape, really, of the energy map when you look at how much they are potentially able to produce in the next few years. But I'm really struck about his tone when it comes to Maduro's troop buildup on the border. The U.S. says this isn't very big in size and scope. Clearly, he's concerned about it. James Stavridis talked about in an opinion piece in December about how Maduro is actually using Putin's playbook when he was bordering up on Ukraine in Donetsk and Luhansk. And potentially that's what's concerning here. Because this is so resource rich, this land that he's fighting over.
It's one to watch for Exxon and others too. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China is ramping up support for its troubled property sector with its biggest cut ever to a key mortgage reference rate. The PBOC announced that lenders will slash their 5-year loan prime rate by 25 bips to 3.95%. The move marks the country's first cut since June and shows an increasing focus to combat the property crisis. The U.S. has proposed a UN Security Council resolution warning against an Israeli assault on Rafah and calling for a temporary ceasefire. That, according to a copy of the draft text seen by Bloomberg. So far, the Biden administration has been reluctant to take steps against Israel, but frustration with Benjamin Netanyahu's government is growing. President Biden says he is willing to meet with House Speaker Mike Johnson to discuss a $95 billion emergency aid package for Ukraine and Israel.
We're making a big mistake not responding. Look, the way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations, it's just shocking. I've been here a while. I've never seen anything like this.
The White House is ramping up its push to pass the bill after the death of Russian opposition leader Alexei Navalny and the recent fall of Ukrainian city. That's your Bloomberg Brief, John.
Danny, thank you. Up next on this program, Capital One agreeing to buy Discover for $35 billion.
If you've got a couple of weak or weaker competitors that are trying to get together for strategic reasons for survival, I think you need to look at that closely as a regulator.
Two stocks to watch going into the opening bell. We'll talk about that next. Live from New York City, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. This is Bloomberg.
We are about 42 minutes away from the opening bell. Equities are lower here by about 1/3% on the S&P. We're totally unchanged on a 10-year, 427.92. Go into the bond market and take a look at the 2-year. We're down about 4 or 5 basis points at the front end of the curve. A break of 460, about 459 on a 2-year this morning. Under surveillance this morning, going into the opening bell, Capital One agreeing to buy Discover for $35 billion.
If you've got a couple of weak or weaker competitors that are trying to get together for strategic reasons for survival, I think you need to look at that closely as a regulator. Regulators haven't minded the duopoly between Visa and MasterCard. So I don't understand why this is, would be a huge issue. So, I mean, I'd hope they'd be able to see past that.
Here's the latest. Capital One agreeing to buy Discover in an all-stock deal. The deal sets the stage for the largest U.S. credit card company by loan volume and is expected to be completed by the end of the year or early 2025, pending regulator approval. Joining us now to discuss is Bloomberg's Shnali Basak. Shnali, great to see you.
Good to see you.
Let's start with the rationale for the deal, and then ultimately that's going to turn to the regulatory stuff. What's the big rationale for this deal?
Well, there's two things here. One, it really increases the scope of the deal. You have a large company that can get a lot of synergies. Remember, this is a company, Capital One, that has $20 billion worth of non-interest expenses alone. So to save a lot of money on marketing, on technology, could really add a lot for them by buying Discover. It also adds a network. Remember, Capital One is an issuer, whereas you have Discover that is a large network as well. So it really gets you inside of the plumbing of the credit card industry for Capital One to buy Discover that they don't have, reducing reliance on Visa and MasterCard.
Often in the press release that they put out is really just a letter to the regulator. Dear regulator, this is why this deal should close. What do you think is going to be the difficulty this year?
Well, one thing you have to remember, they have changed a lot of guidelines when it comes to bank mergers. And so they waited until the OCC and the Fed and the DOJ came out with those new proposals. So you have to understand that they have a certain degree of certainty, that those overlaps don't exist pertaining to the new guidelines for these regulators here.
Well, this raises this question of what would the rationale be then for regulators? Because we're looking at a premium, if this were to go through, of more than 20% for Discover. Those shares up just north of 12%. It's a pretty hefty discount for this not going through. What's the main obstacle at a time where they're not that strong in terms of players and they're facing off against a pretty strong set of banks?
They highlighted that network capability for a very specific reason here, Lisa, because if you take just the loan volumes by themselves, you have the number 3 and the number 6 company merging. So that would make it the number 1. But you're not talking about JP Morgan and Citigroup merging. You're not talking about 1 and 2 getting bigger. You are making Discover bigger, is really what you're doing in this regard, and helping them compete with the banks. The network, you have Discover a lot smaller than Visa and MasterCard. So while they're highlighting the network, they're really starting to highlight something that Discover is way lower down on the totem pole here to give them scale to compete with 2 and 3.
It also raises this question around Capital One traditionally doing a lot of business among lower income families, a lot of subprime loans in a whole host of different categories, and Discover being more prime and uniting the two. And there's a real question of whether this is a cyclical play, about whether this is something that other banks are trying to get into in terms of credit cards at a time where those outstandings are going up, or whether this is sort of protection against the downside.
Yeah, and that's one of the greatest questions. Right before I came here, I tried to take a look at just how different they are. And you have Capital One with almost a third of their customer base here, looking at FICO scores of less than 660, where that's less than a fifth for Discover. So really, they are really rounding out their base here. Now, if you're a regulator, what you might ask is, what does that mean for the people with FICO scores under 660? You start to worry there about what the consumer base looks like. We already know Capital One has been starting to inch higher on the more luxury, more well-capitalized segment of Americans and consumers, but what then happens for those folks who are being left behind in the system?
It's a major question. We've talked about, I think it was Bank of America, wasn't it, when we talked about just how strong the consumers that they serve actually are.
Yeah, it's interesting. You have most Americans have FICO scores well over 700, right? And you have had a lot of these banks starting to shed FICO scores. You're going to have, if you have 2 large credit card companies like this merging, a worry lower end of the spectrum. Guys, you have to think about the macro backdrop here as well, because they're doing this at a time where many companies are already tightening standards. So if you go back over the last decade, you have kind of historically tighter standards today than you would have had in 2021 and 2022, and even in the period leading up to the pandemic.
What's your big takeaway from the deal activity we've seen so far this year? A lot of it's been all stock deals. Any big signal there for you?
Well, one thing is you have the winners and the losers, right? Remember, there was a divergence between Capital One and Discover here because Discover had their stock really lagging behind because of those regulatory issues. And so if you have stock that is worth enough to buy somebody that is lagging behind a little bit, now's the time to pounce because of that divergence. Plus, the regulatory picture is becoming more clear.
We're seeing a lot of that. Shnali, thank you. It's good to hear from you. 2 stocks to watch going into the opening bell. Coming up tomorrow, just a snapshot, a sneak peek of the lineup for you. John Stolfers of Oppenheimer Asset Management, Mike Schumacher of Wells Fargo, Binky Chadha of Deutsche Bank, and the Marriott president and CEO, Tony Capuano. Looking forward to all of that. Lisa, 2 upgrades, one from Goldman on the S&P 500, another from Jonathan Golub over at UBS in the last couple of hours.
Yeah, talking about potentially increasing it beyond the 5,200 even, that a lot of people are calling for. You have to wonder exactly what's behind this. Is it the big 7, the magnificent 2, whatever you want to call it? Is it them that just continue to drive this, or is it the broadening out that people talk about? It's kind of key in terms of the economic backdrop and rate cuts and how that plays out.
The dominant one. What did you call it? NVIDIA? What did you call it earlier?
I forgot.
Earnings coming up after the close tomorrow.
Oh, outstanding.
The outstanding
one.
Up more than 40% already year to date after just absolutely rocketing through last year.
It's like the golden child. It's like the one that everyone kind of hates, but they also kind of aspire to be.
The siblings hate?
Yes, the siblings.
But the parents love?
Well,
the parents in this analogy, the investor? Is that where we're going with this?
I was going to try to go there. And then I'm quickly cycling back, and let's move on.
I just wonder how important Federal Reserve policy actually is. I keep going back to the price action in last week. You push back rate cut expectations further off the back of hotter CPI, hotter PPI, which is the bad reason to push back rate cuts. And then equities fell by what? 0.4%, 0.5%? That's nothing.
The big mystery for me, honestly, is just where we are in terms of neutral. If 4% is the new neutral, that will be a very different reality for people who say that companies can exist at that level, but the Fed's not going to cut that much. That's not going to turbocharge certain fixed income investments, but it will allow certain equity investments to do okay.
Matt Lazzetti, chief U.S. economist over at Deutsche Bank, on top of that story. Federal Reserve minutes coming out tomorrow. Look out for that. Just how much agreement or disagreement division was there on the FOMC? Given how uncomfortable Chairman Powell looked in that news conference, trying to reflect the consensus or lack thereof on the committee, I have to say that since we've heard from Fed officials over the last few weeks, they seem pretty in line with each other. So I'm wondering what was going on in that press conference.
It's a good question. It sort of raises this issue. Are they basically saying the same words but having a different meaning behind them? Seriously, it's sort of, you know, when you're talking with somebody and you're speaking a similar language, but when you dig a little deeper, you're actually talking about something different. I wonder if that's sort of the measure of how to get, you know, sort of to that level where they're ready to cut.
I think we hear from Bostic tomorrow morning. Then Thursday, if you missed it, the lineup for Fed Speak: Jefferson, Bauman, Harker, Cook, Kashkari and Waller. So basically the whole committee. From New York City, equity futures slightly negative. We're down 1/3 of 1%. Your opening bell about 34 minutes away.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Crenny in for Jonathan Ferro. Do you have pre-stage NVIDIA nerves? These equity markets do ahead of those numbers tomorrow. Let's see how we go down as we count down to the market open. It begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up in the show, markets on edge as traders start questioning the Fed's next move. Earnings season failing to move the needle, with NVIDIA angst up next. And it's the biggest deal of 2024. Capital One agrees to buy Discover for $35 billion. But we begin with that big issue. Is the consumer starting to crack?
The consumer has been trading down. I mean, we do continue to see that. And I think Walmart's strength reflects some of that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed.
Walmart topping the earnings estimates, but delivering a relatively subdued outlook. Home Depot posts the 5th consecutive decline in quarterly sales. So what does it all mean for the consumer and for markets? Let's bring in my guests this morning to join the conversation. BlackRock's Tony DeSpirito and Sonal Desai from Franklin Templeton. Good to have you with us. Two huge reports which in some ways tell us a little bit about how the consumer feels right now. Tony, good morning. The language used in the report from Walmart strikes a restrained kind of tone. First take?
Yeah, so look, I think if you look at the economy has been very strong and even maybe accelerating. If you look at fourth quarter GDP, or if you look at GDP now estimates for the first quarter this year. So I would say the economy is good. Then you look at jobs. Unemployment's 3.7%. That's really good. And then you look at wages. Wages are also been very strong. So I think broadly the U.S. consumer is still in very good shape. Now, there are a few yellow flags that would think of us maybe having a little bit of a slowdown here. You know, if you just look at consumer savings rates, they are low relative to history. The consumer savings rate last report was 3.7%. I would think of something a little bit north of 6 as more normal. So you would expect it to slow down a bit, but I think the consumer is still really strong, and any worries about the U.S. consumer are misplaced.
Yeah, UBS's favorite phrase, don't ever bet against the hedonism of the U.S. consumer. Sonal, good morning to you. Good to see you. In terms of the takeaways for the bond fixed income investor from an equity report, it's always hard to discern. But in terms of that cautiousness from the consumer, it could be an indicative to pricing and to that disinflation narrative.
So I think that the real thing here to think about is that the disinflation narrative got ahead of itself. We have always said, I've always said, the move from 9 to 4 was going to be a lot easier than from 4 to 2, and I think we're kind of stuck where we are. So it's less about the bond market. You know, if I look at 10-year yields, I don't think 10-year yields are ahead of themselves. What was ahead of itself, in a sense, was the pricing of Fed rate cuts, which I think had gone way too far. And on balance, I would say, equally overdone are the new fears that the Fed is going to hike next. I do think that it's in line with the idea that rate cuts get pushed into the second half of the year. And on balance, the Fed may choose to go 50 instead of 75.
Okay, well, let's dig a little bit deeper into these two reports. We've got Katie Greifeld alongside me. We've got the retail earnings rolling out. Mixed results, Walmart and Home Depot this morning. Katie Greifeld joins me on breaking those numbers down. So, Katie, what is the language here? They are being choiceful at Walmart in the aisles.
Choosy when it comes to Walmart. And you actually see shares quite higher, even though it did come out with that language. Take a look at Home Depot. It's down in the wake of these results. So let's start with the bad news. Let's start with Home Depot, because that is a fifth quarter of comp sale declines that we learned for Home Depot in this report. Specifically, comp sales fell 3.5% in the fourth quarter, but Home Depot said it also expects a 1% drop in comp sales for the entire year. That is what is dragging down the stock right now. So that downbeat forecast, like most things at the moment, Manis, that comes down to higher interest rates, mortgage rates in Home Depot's case. They're still very high. That is weighing on home sales and new construction. As a result, demand for home improvement. A different story over at Walmart, like I mentioned. It actually topped estimates. It did deliver soft guidance for the current fiscal year, as you said, citing those selective spenders. But the CFO was quick to point out that Walmart is gaining share in nearly every category, perhaps, of course, as consumers trade down. Walmart also said it's buying smart TV maker Vizio for about $2.3 billion just to top things off. So that's the setup as we really head into the heart of retail earnings.
Yeah, it is a Goliath, isn't it? Just captures everything on the way up and on the way down. You're just riding those waves like pure surf. Katie, thank you very much. My guests this morning are Tony DeSpirito and Sonal Desai. They join me to discuss where we are. I look at last week, I look at the beginning of this week, and I look at the three incidences that took place: PPI, CPI, or chronologically CPI, PPI, and University of Michigan, which UBS, I had them with me this morning. Michigan consumer sentiment data is entertainment and not substance. We can debate that in a moment. The backup in yields, Sonal, good morning. Where are we? Do we go into some kind of suspended animation on inflation and rates in this medium term? Sonal.
So, I have been calling for a higher neutral rate for quite a while. I think the neutral rate for the US is closer to 4 than to 2.25, which is what the Fed has been calling for and what markets anticipate. And I would just say, if neutral is at around 4, with Fed funds at 5.25 to 5.5, sure, we're restrictive, but we're not as restrictive as potentially we would be if we thought neutral was at 2. Now, this matters because it just means that you will get a more drawn-out return to that 2% target. It doesn't mean that the Fed has to jump right back into a hiking cycle, but it just means you delay that cutting cycle. And if I look at the real economy is in a good place to maintain this level of rates. Sure, it's not fantastic. I see that. You see that in Home Depot's earnings, you see that in mortgage rates, all of the above. But the reality is the economy is not tanking here.
No.
So do we go to suspended animation 4.25 to 4.5 for 10 years? I think that's not a bad place for 10 years to land.
Do you think you're slightly on the right-hand tail risk there of assessing where the neutral rate is at 4?
Oh, I think I'm way out there at 4.
I was trying to be gracious and sort of not very confrontational.
But I think it is way out there. But here's the thing. Think about where we're coming from. You look at productivity. If we see productivity over the last 9 months, it's picked up quite substantially. If you actually look at where did I say neutral real rates? I said 4% nominal for Fed
4%
funds.
nominal, excuse me.
Yes, excuse me. But real rates, if I look at where Fed funds neutral real rates were from the 1950s all the way until the global financial crisis, we really were looking at 2.5, yeah? So if you think about inflation at 2, and you think that real rates actually need to be closer to where they were historically prior to the global financial crisis and the flooding of markets with liquidity, it doesn't take a lot to get you up to 4.
No, it does not. It does not.
And I think it's reasonable. If you think productivity has picked up, which actually does appear to be happening, if this is that final pickup in productivity, that would also argue for higher neutral rates.
Tony, where do you come in on this debate, and how important is it for the equity narrative for you to continue to deploy, given what we've just heard Sanal put forward in terms of the neutral rate?
Sure. So from an equity perspective, the way we look at it is there's earnings on the top, on the numerator, and then the denominator is essentially the risk-free rate. And that's your calculation of what the S&P 500 is worth. And a couple of things. One is I looked at the economy, and again, I think the economy has proven amazing resilience. Inflation's coming down. Yeah, we saw a little bit of a blip up in January, but I don't think that's an inflection point. I don't think that's a change in the direction of travel. And so I think the economy is healthy. So that probably means good things for earnings growth. And you're seeing companies be really aggressive in terms of right-sizing, extracting operational efficiencies, et cetera. So I see earnings as fairly healthy. And then when it comes to discount rates, I accept the 10-year Treasury where it is. And when I look at it on that basis, stocks look pretty decent to me. The other thing I would comment is when you look at the S&P 500, while that P multiple looks high relative to historical averages, the S&P 500 has also become a lot more of a growth index over time, as it's dominated by the Magnificent Seven. And so you really need to look at the equally weighted S&P 500, which is at a discount of about 23, 24% versus the S&P 500. Its multiple is only about 17 times, looks much more in line with historical averages. So I look at rates, and I think where we are is just fine.
Okay, you've both touched on the seminal theme, which is productivity. We're trying to work out what AI will do for productivity. None of us know. And anybody who comes on this TV show and tries to say that they understand what that's going to impact be, I would question them aggressively. But Tony, to you, you said we need to be nimble to know where the opportunity is at a given stage of the progress. Makes investing in Gen AI very much an active pursuit. And this is as Gen AI itself sharpens, smartens, and evolves. We have NVIDIA angst this morning. We've had it for about 5 days or so. We're getting ready for NVIDIA. But when you look at nimbleness within AI and within tech, can you just shine a light on that? What does that really mean for investors?
Well, I have two comments. One's about the tech indices and about indices broadly, and then the other comment's about the evolution of AI. In terms of the indices, what we're seeing is more and more concentration in the indices. And if you look at the academic literature on diversification, some of these indexes are becoming less and less diversified. I'll take the world tech benchmark, so not just a US, a world tech benchmark. 3 companies account for about 45% of the weight in the benchmark. No one would call that a diversified portfolio. So I think in some of these areas, active management's becoming increasingly important as the indices become increasingly skewed. So that's a general comment on active management. I think in technology, active is particularly important. You know, we think about AI in terms of a tech stack, right? And at the bottom layer of that tech stack is the hardware, the chips, the servers, et cetera. And that's where all the attention is right now. That's largely well known. What's more interesting is as you move up the tech stack to the software layer, and ultimately to the data layer, that's where it gets really interesting. And so I think some of the most interesting investments we in BlackRock and fundamental equities are making today are at that data level. Companies that have their own unique proprietary data sets, where those data sets, you know, they're valuable today, but they become even more valuable with AI. The data becomes more productive, more valuable, and these companies can price up for it. So what we're doing is kind of moving up along that tech stack from the hardware layer to the software layer, ultimately to the data layer itself. And that requires real fundamental research.
And that's where value evolves over time rather than just a 200% return on equity in the space of a month and a half. Tony, stay with us, Sanal. Great to have you with me this morning. My guests on the markets. Let's get across to Abigail Doolittle. She's side by side with me, looking ahead of the opening bell. What have we got, Abby?
Well, we may have the futures lower at this point, Manus, but we do have at least one stock that is soaring. And of course, I'm talking about Discover Financial, up at this point, up 12.4% on the news that Capital One has agreed to buy them for $35 billion. The biggest deal of the year that brings together 2 of the biggest credit card companies to compete with some of the huge money center banks. Walmart up nearly 5%, heading to a record high on the open. Strong quarter, store sales of 4% were better than the 3.1% estimate. And of course, it was confirmed that they are buying the TV maker Vizio. And then Home Depot down 2.3%, as Katie was talking about earlier, the 5th straight quarter of comp sales declining. In this case, down 3.5%. Some analysts are saying the guidance is underwhelming. And apparently, high mortgage rates are impacting DIY demand. And, well, we have those shares down 2.4%, a big contrast to the gain that we're seeing for Walmart.
I got to get myself back to Home Depot, pick up a little bit of extra kit. Abby, thank you very much. Abigail Doolittle there. Coming up on the show, the Fed officials, guess what? They're pushing back.
To finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed.
The Fed staying on message there, urging patience ahead of another busy slate of Fed speak. That conversation next on Bloomberg.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed and be prepared to respond agilely as the economy evolves.
Fortitude, that's what you need. Fed officials continuing to push back, urging patience on hotter than expected data, fueling concerns that the Fed could soon reverse course.
I think that May is odds off at this point and probably should be odds off. And gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards in rates.
That was the former Treasury Secretary Larry Summers discussing the current state of play, setting the stage for another busy slate of Fed speak. Mike McKee is with me, so we get minutes on Fed speak. How much of a Shakespearean clack can I expect this week?
I don't think you're going to get that much, and I'll tell you why. Let's, as Larry said, set up where we are and where we have been. Take a look at the yield curve. January 15th, Governor Chris Waller came out and said, we can cut rates this year, but we're going to have to be measured and slow. Since that date, look what's happened to the yield curve. The white line is today. We've gone up across the curve in everything. Now, will the Fed say anything this week to change that? It's a very light week for economic data. Basically, the only thing that's going to matter to the markets is jobless claims on Thursday. And we get Fed minutes tomorrow, which may or may not tell us something about when they're thinking about cutting, because it's been 3 weeks since that last meeting. Thursday, we also get a ton of Fed speak. You saw the calendar there. But does any of that matter? Because on March 6th, Jay Powell goes to Capitol Hill for his twice yearly, formerly known as Humphrey Hawkins testimony, and that'll really set the market up for what's going to happen. What does the market think is going to happen? Well, as you saw from the change in the yield curve, we've had quite a change in belief about when the Fed might move. Right now, we're looking, if you look over the whole year, at about a 23% chance of a 50 basis point move, a 23% chance of a 75 basis point move, and look at what's all the way over on the end there. Manus, that's the 6% chance that is now being priced into the markets of a rate hike, probably because of Larry Summers. And maybe this is something that Larry did to distract people from the beard that he has grown. Bill Dudley, the former New York Fed president, has a more natural explanation for what the Fed might be looking at out there. And he thinks that the neutral rate has gotten higher because the economy's gotten stronger. And that means the Fed will cut less. If you look at what the projection, one projection for the neutral rate is and where the Fed is, you can see that right now 125 basis points is the most that would project for a cut. So everybody will be looking for clues this week to where we are on that total yield curve, forward-looking. What are we going to do next?
Okay, Mike, thank you very much. Beautifully put, Mike McKee there. Tony DeSpirito, Sonal Desai are my guests this morning. Sonal, would you be a buyer of the tail risk of a 6% possibility of a hike? Would you be a buyer at all of another hike? I know, but I'm just throwing it out there. Go on.
Tail risk, sure. I'd say it's a tail risk, but honestly, there are many things that are tail risks. There's a tail risk that you get 200 basis points of cuts, right? And I think both are not very likely at all.
Okay. You would also say, look, it's hardly surprising disinflation has stalled. The supply side has improved. Take out the Red Sea for the moment. That could be the spoiler alert in all of this. But you're more focused on the demand side, and it is that robust demand side that you're flying the flag for, isn't it?
It is, because, you know, we periodically in the market come back to talking about fiscal policy, then we stop talking about fiscal policy. But the reality is fiscal policy is alive and well and continues to stimulate the economy. And I think that's something which is important. Wages are doing quite well. When I spoke about productivity earlier, by the way, I was not talking about generative AI. I was talking about the last 10 years of CapEx, which has just simply not shown up in productivity. We might finally be seeing that as we did in the early 2000s when we saw the impact of the internet boom in the 1990s and 2000s. So my view here is really that the economy, if anything, is in fairly rude good health. It's tolerating the higher interest rates. That in and of itself is an indication that the neutral rate is higher. In turn, it means that the Fed has the luxury of waiting. Why would they cut when they don't need to?
Indeed. Well, as Mary Daly just said, you know, you need fortitude, you need patience, and they need confidence. Let me bring that back to you in terms of the equity side. UBS have upped their guidance for this year, Tony, to 50. Let me just double check. UBS has gone to 5,400. Goldman Sachs has gone to 5,200. So, I mean, these are not huge uplifts, but they are quite significant qualifications to the bullish scenario on earnings. Would you share this level of bullishness?
So one of the positives that we've seen is if you look at estimates for 2024, you know, there's a natural pattern of how estimates evolve over the course of the year. They kind of usually start high and then come down over time. And what we're seeing is they're coming down less than normal, less than average. And so that tells us that corporate expectations for earnings and guidance that we're getting is for 2024 in general is quite robust. And so that's the real positive, and ultimately, that's the positive driver for equity markets.
Okay, well, they're going for $240 this year, up from 235. So they're going for high single-digit increase in earnings. Thank you so much for joining me, and well done, Sonal. As you say, I can throw any tail risk in there, and there's plenty of them. A 200 basis point cut in there as well. Tony, thank you very much. Tony DeSpirito, Sonal Desai, keeping it real on the tail risk. Coming up, your morning calls. We have Joanne Feeney a little bit later on. Advisors Capital Management joining me for the conversation on the tech moment we're facing in the next 24 hours. It is a make or break moment for sentiment. Is it? This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Ahead of the NVIDIA results, counting down. This is what we got for you. Deutsche Bank upgrades JetBlue to a buy, pointing to improving domestic supply backdrop. Next up, Evercore downgrading Caterpillar to in line, recommending investors start taking your profits on sectors that have had a outperformance recently. And finally, Bank of America downgrades AIG to neutral, expecting a challenging year ahead of margins and top-line revenue growth. Coming up, Feeney of Advisors Capital.
That at the very least the situation between China and the US is calming down, and at this stage we just don't need something else coming for sure.
Are you confident, actually, that the U.S.-China relationship will get better?
No, I'm not confident because I'm not in control of that. But what I know is that the world cannot afford an escalation, and most likely both countries cannot really afford some things to escalate in terms of economic consequences. I mean, the situation in both countries is fragile, and you know, I guess a geopolitical escalation is not going to be in the interest of both countries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This is Bloomberg.
See, eventually football comes home to America. Major League Soccer, they're looking happy over at the NASDAQ. Not so happy on the stock front. You've got Tesla and NVIDIA. There is NVIDIA angst. It's going to be a big swing factor, according to Mr. Emmanuel over at Barclays, ending up to 10, 15%. If they don't fill on the nail with the numbers, it could drag these markets lower. We're lower on tech, but there are outstanders. We'll bring that to you. There is the opening bell. Equity markets are set to open a little bit lower after President's Day. So that's the state of play there. We've had this jolt in yields on Friday, looking at the highest level that we've seen in 2024. You're looking at a 10-year paper this morning, giving a tick or two back. Euro dollar, this is the euro up by 0.5%. And you have crude trading up 0.7% at 79.77. So a little bit of an ad there on the oil market. Two stocks to watch. It's all about the deals that have been announced. Capital One and Discover Financial. Capital One agreeing to buy Discover for $35 billion, creating the largest U.S. credit card company by loan volume. Abigail Doolittle has the details. How is the market taking this, Abby? Good morning.
Good morning. And Discover holders are very happy about this. The stock right now about 12%. Its best day since November of 2020. For Capital One, not so much, but that's not so surprising given the fact that when a company acquires another company, you'll often see those shares shrink. So in the case of Capital One today, down nearly 5%. Relative to the potential deal, as you mentioned, Capital One has agreed to buy Discover Financial for $35 billion. Discover shareholders will receive a little more than one share of Capital One. That represents a 26.6% premium. You can see, though, that the Discover share is up about 11%. That suggests that investors and analysts, market forces believe that there could be some reason that this deal doesn't happen. Now, I could take a guess that that could be the FTC or regulatory hurdles and the terms of fears around some sort of a monopoly. We don't know that's the case, but that is a very, very wide spread between the big gain that we do see Discover having and the premium that was offered. Now, as you mentioned, the combined entity and the reason for the deal on the part of Capital One is to be the biggest credit card lender. Their assets together would be above $250 billion. Take Citi and JP Morgan, the next largest, both around or below $200 billion. As for Discover, well, this gives them a way out of some of their legal overhang and what some analysts are calling a weak 2024 outlook, Manus.
It's going to create a behemoth, isn't it, in terms of the credit card data, information, and size. Abby, thank you very much. Abigail Doolittle. Let's turn our attention to the chips. I mentioned Intel in the opening calls. It's in talks with the Biden administration to give more than $10 billion in subsidies to the chip maker. That's according to Bloomberg reporting. Simone Foxman has the Bloomberg scoop.
Yeah, Manas, sources telling Bloomberg that this is going to split, but we're not quite sure how it's going to split between the $39 billion that the Commerce Department has earmarked in grants and the $75 billion that they've earmarked in loans. According to our sources, these negotiations are ongoing, but we could get an announcement in the coming weeks. Citi, in a research note this morning, speculates that we actually could get it tomorrow. Tomorrow is Intel's Global Foundry Day. U.S. Commerce Secretary Gina Raimondo is expected to speak there. One of the other things likely helping Intel this morning is an announcement that Global Foundries will also receive grants, $1.5 billion in grants, $1.6 billion in loans as part of these CHIPS Act programs. Now, Global Foundries is going to ramp up its manufacturing in New York and Vermont. Intel has enormous plans, much bigger plans to do so across the country, a $20 billion factory in Ohio. That would be the world's largest $20 billion expansion in Arizona, and $3.5 billion investment in New Mexico among its plans. That said, it has struggled to keep pace with rivals, especially TSMC, and Citi says Intel is still far behind in the tech, and ultimately, despite all these grants and loans that it may get, it's going to be extremely difficult to battle TSMC. However, you have CITIC also initiating a coverage with a buy at $55 a share. The news eliminating some of the losses that Intel has felt this year, though the share is still down over 10%, Manis.
Okay, Simone, thank you very much with the very latest on the chips in the globe and the Inflation Act and how it is being deployed. Let's get back to the earnings, and it's a tale of two retailers. As we've been saying, Walmart jumping on better than expected results. Home Depot under pressure after posting a 5th consecutive decline in quarterly sales. Katie Greifeld is side by side with me this morning. I mean, this is about Walmart's power and influence and the reality of a post-COVID change of the amount of DIY we're doing.
Exactly. I mean, Walmart, it really had a strong quarter. It topped estimates. It did, though, deliver weak guidance when it comes to the current fiscal quarter, though the CFO was quick to brush that aside. He said that consumers, they're being choiceful. They continue to spend less per trip, but they have been shopping frequently, and of course pointing out that Walmart, it's gaining share in nearly every category. So like you say, still very dominant here, dominant in the stock market this morning as well, up over 5%. It's a different story when it comes to Home Depot. We were talking about the 5th quarter of comp sales declines for Home Depot. To get into the numbers here, comp sales fell 3.5% in the 4th quarter. That is slightly better than expectations, but again, that's a size and scope there. And then you look at their forecast for the full year, and that actually they're expecting a 1% drop in comp sales. Analysts had actually been looking for a 0.2% improvement, so a disappointment there. And as we were talking about just a few minutes ago, of course, that comes back to high mortgage rates. That has pretty much frozen the housing markets. Even though you have seen mortgage rates come down a little bit, they're still very high, and that means there's less demand for home improvement, which Home Depot, that's their bread and butter. So that's the setup. Again, Manis, you can see Home Depot shares currently about 1% lower.
Okay, I'm off to Home Depot for the hard hat and the tool belt. Katie, thank you very much. Joining me tonight to talk about the consumer is Joanne Feeney, partner and portfolio manager over Advisors Capital Management. Joanne, good to have you with me. Very different stories, aren't they? Walmart to Home Depot, Walmart size and breadth. It is so significant. But they talk about a caution in the consumer. You don't want to overemphasize that, but do you take anything away from that cautionary tone about how the Walmart consumer is behaving?
Yeah, Magnus, I think we've seen that from a lot of companies this earnings season, and it's not surprising. I mean, you have to look at the consumer as not one generic consumer, right? We have consumers at different points and places in the income distribution, and those folks that are down at the lower end of the distribution or even the middle range have been having to deal with these higher prices. And so, yeah, they're going to be more selective about where they spend their money. And Walmart related that. We own Walmart in places. We also own TJ Maxx and Target because we see that dynamic continuing to play out. But overall, we have more people employed than we've had ever. They're making good wages. Their real disposable personal income has been rising. So overall spending from the consumer remains quite strong.
Yeah, I mean, as you say, we're sub 4% employment numbers. We haven't had that in decades. You talk about, though, confusion in the economy. The Fed is talking about wanting more confidence about cutting rates. What is the most confusing aspect of the economy because wages are strong, jobs are plentiful, disinflation is taking place, maybe not as fast as everybody had estimated. But what is the most confusing part for you?
Yeah, Magnus, I put out a commentary this morning about this because, you listen to earnings calls and some companies say, hey, the macro economy is challenging, demand is weak. Other companies are saying, hey, strong 2023, we expect another strong year in 2024. So what gives? I mean, if the economy is strong, why isn't everybody saying that? And if the economy is heading towards recession, why isn't everybody warning us? And we're seeing a mixture of information out there. And the reason is because different parts of the economy are in different parts of the business cycle. So some companies, like in the chip industry, some of those companies are saying, hey, we've had our customers already build up their inventory. They don't need more right now. They're cutting their orders. While other companies in the chip industry, like say AMD or NVIDIA, are seeing continued strength in demand because data centers are building out this new AI capability. So you really have to parse the data, look at individual companies and see where they are in their business cycles. And then, of course, our view is you invest for the long term. Try to work through these cycles and stay with quality companies.
I'm looking at the news flow this morning. It's about Intel potentially getting $10 billion of a grant, Global Foundries perhaps a tenth of that. Now, a lot of this is obviously wrapped around the Biden administration's policy. This is about protecting America. It's about technology independence. It is about onshoring, friendshoring, if you want to call it. It's any myriad of those things. When you see this kind of subsidy coming through to the likes of Intel and Global Foundries, does that set a stronger argument for these stocks relative to NVIDIA? Do you have to look beyond NVIDIA? And if so, in the chip space, where do you do that?
Yeah, Magnus, I mean, clearly these subsidies are going to help around the margins on the depreciation costs that these companies ultimately will record down the line. It'll be less expensive to build these new factories. And so that'll pass through to profits. And you're right, and that's not going to help an NVIDIA that doesn't have its own manufacturing capabilities. But when you look at the long-term investing opportunity, that is one factor. It's not just Intel that's going to receive these benefits. We saw Global Foundries, but in addition, Texas Instruments, Microchip, other, perhaps less flashy U.S. Semiconductor designers and producers are also standing to benefit. And so on the margin, it's going to help their profitability. But overall, when you're looking to assemble a portfolio with some exposure to technology, you want to look also for the secular growth in their end markets. And in semiconductors, it's a pretty good opportunity because content, that is the number of chips in everything, from consumer products to industrials to autos, is rising. And that content points to long-term secular growth opportunities. So there's a lot to choose from out there. You have to just figure out what your horizon is for investing, your risk tolerance, because obviously an NVIDIA is quite different from a Texas Instruments.
Well, let's just pause and think about those earnings because they're coming down in the next 24 hours. So the NVIDIA results, they'll come after the closing bell tomorrow, and it could have major implications across the risk and the proclivity for risk globally. Alex Webb is with me. Alex, what am I going to be focused on this result set?
As ever, the forecast is going to be front and center. The market is looking for revenue in the order of $22 billion. That would be compared to the $20.4 billion that they're expecting for the quarter that just ended. Let's put that in some context. The company itself is forecasting for this quarter that we'll see the results for of 20 billion plus or minus 2%. The market therefore is expecting the very top of that, the 20.4. It does mean that if there's any, in order to meet expectations, they probably kind of have to beat expectations. Anything less than that, given the scale of the expectations, is likely to be disappointing. Sometimes though, it's easy to think that the expectations are so sky high that you can't possibly meet them. It's important to remember that NVIDIA is trading at about 35 times its forward earnings, and that isn't actually massively outside of the realms of what some of its peers are doing. In fact, AMD is trading at a far higher multiple. Microsoft is also trading at about 33 times its forward earnings. So yes, expectations are high, but they're not unrealistic.
Okay, let's take that thought back to my guest this morning, to Joanne Feeney. Joanne, when you hear that kind of comparison on multiples, do you still feel brave to step in? How defining a moment for risk for 2024 will these NVIDIA results be tomorrow?
I don't think the NVIDIA results will be all that informative about risk. I mean, clearly NVIDIA is in the middle of a investment stage for generative AI. We're seeing those capabilities be built, and those are expensive. Lots of chips are required. In fact, it looks still like NVIDIA is constrained on how many chips they can sell into the market because of production limitations, packaging limitations, et cetera. So, whether they beat or miss or guide to where the investors expect they will is an incremental piece of information, unless they say something like, oh, sorry, we thought there was going to be demand, but it has suddenly evaporated. We don't see that as a possibility. And that would really be the only, significant information. So I suspect, they're going to either beat or meet expectations, but it's really largely going to do with their capacity of their partners to produce the chips for NVIDIA. And so that's not so informative. What we really care about is the long-term potential of generative AI and how quickly companies want to create the capacity to run these new models, the large language models and other applications that we're just beginning to see. It looks to us like there's a really long runway ahead and that we're just getting started on the applications that are going to be rolled out. Look to the software companies for other places to get information about the uptake of AI.
It seems as if we spend an inordinate amount and an outsized amount of time talking about NVIDIA as if there's nothing else. But you also make it very clear that if you pay attention to the earnings calls, specifically within tech, and whether that's Texas Instruments or whether that is Cisco, you are a buyer of fissures. Perhaps if you listen to the calls, you want to take advantage of them. Why Texas? Why Cisco? Briefly.
Yeah, both of those recently had what some would call weak earnings reports, weak guidance, and they're in a cyclical inventory correction among their customers, and so their guidance wasn't particularly strong. They're citing a slowdown in demand from their industrial customers, from some of their enterprise customers, and that's often a good time to buy these companies because overall, the long term is very, very encouraging. More semiconductor content, more communications network infrastructure is going to be required over the next 5 to 10 years, and these are two very well companies, pay a dividend, a good place to be for the longer term.
Okay, Joanne, thank you so much for being with us there, Joanne Feeney. My guest on all things tech and market risk. Coming up on the show, it is the biggest deal of 2024.
Companies are looking for opportunities to expand, to acquire innovation and new technologies, developments. That's a fairly normal thing given the structural cycle that we are in.
Capital One agrees to buy Discover for $35 billion. The deal in conversation, that's ahead on Bloomberg.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Companies are looking for opportunities to expand, to acquire innovation and new technologies, developments. That's a fairly normal thing given the structural cycle that we are in. We're not in the sort of frenzy of M&A that we've seen in the past, but that I think is also logical because we're in a more normalized interest rate environment now.
So the deal is in. Capital One agrees to buy Discover Financial. Price tag, $35 billion, creating the largest U.S. credit card company by loan volume and opening the door to greater competition against other giants on Wall Street. The transaction is expected to close later this year or early next, pending regulatory and shareholder approvals. Shonali Basak is with me now. Shonali, I'm looking at Capital One. There's dissent in the ranks. Have they overpaid? Have they overreached? What have you got?
One interesting example that we've been given here by Bloomberg Opinion's Chris Hughes is that if they had waited to buy Capital One here, for Capital One to buy Discover shareholders get 40% of the combined company. Had they not waited, had they done this before Discover hit some of its regulatory issues, they would have had 50% of the company. So you do have a discount here to some degree that Capital One is getting to buy Discover. But remember, there are a lot of questions still about this deal. This would be one of the largest deals, since the financial crisis in financial services. And you do have here a number of regulatory matters that Discover has been contending to, hiring hundreds of people to meet those regulatory concerns. And then there's the matter of antitrust and how regulators will look at the deal that would combine 2 of the top 6 companies by credit card loan volumes in the United States, let alone the globe, really, here. So what you have is really the case that Capital One is making, that it would add for them a network. Remember, it's an issuer that you're seeing primarily in Capital One. It is a diversifying business to add a network the size of Discover, and therefore you have a different company, even though 1 and 2 make, or 3 and 6 in this case rather, make number 1 in terms of loan values of itself.
So where are we on the M&A? I mean, we saw some pretty big deals go through on the oil majors, and that's about integration in the Permian. Here we are, the first major financial deal which has not been pushed through because of angst in the market. How does it set the stage for 2024 then, Shonali?
You have to understand that by this deal and the deal you're seeing for Walmart in itself, you have deal volumes up about 55% from when they were last year. And part of that is not only the market starting to find some ease in itself, you also see divergence in major players here, valuations starting to find a floor in which it is appropriate for those larger companies to buy ones that have been left behind. And then there's that regulatory certainty, Manus. When you think about even just Capital One, for example, it comes after the OCC and the DOJ have outlined new guidelines for mergers. The Federal Reserve stress test scenarios have come out. There is a sense of clarity here for major acquirers to come out in a way they have not in the past year. And another fun fact for you, the deal advisors, more boutiques on this deal. The deal fees are going to smaller banks in this environment. And so let's see if that plays out through the remainder of 2024.
Okay, well, we certainly know that those investment banking teams are beefing up for a pretty good year of deals. Let's see if it plays out. Shonali, thank you very much. On the latest with the deal flow. Some price action, sector price action this morning. Let's get back to Abigail Doolittle.
We're looking at some weak action, not just for sectors, but overall. The Nasdaq 100 down more than 1%. The S&P 500 right now down more than 0.6%. From a composition standpoint, yes, weakness there too, because we have more sectors that are down than not. Starting off with tech and consumer discretionary. We also have communication services. Speaking of the financials, among the worst, but it's really discretionary and technology, both down more than 1%. We'll be taking a look at a piece of that in a moment. But those are those heavyweight sectors, so really weighing. To the upside, we have the three defensive sectors, basically, consumer staples, utilities, and healthcare. So the fact that you have those three defensive sectors higher is risk off, because it tells you which way investors are leaning. As for that heaviness for tech, well, a lot of it has to do with what you were talking about earlier, and that is NVIDIA and fear around it. The valuation has that stock on too far right now, down sharply, weighing on the chip index. You can see over the last 6 days, it is down 5 of those 6 days, and overall down 3.4%. Not a great way for these stocks to trade into that report tomorrow, Manus.
Yeah, but as we've heard, the valuation on that stock is not that stretched relative to some of the others in the peer and in the sector. Abby, thank you very much for breaking it down this Tuesday morning. Coming up in the show, market moving events. We're building up to Fed Speak and Fed Minutes. I'll give you your trading diary in just a moment.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Punchy drop on stocks this morning. They're nervous on NVIDIA. That's what's dragging the Nasdaq lower. And of course, this Fed, it could be a little bit restrained in terms of the action on rate cuts. Your trading diary, we're counting down to the NVIDIA report card tomorrow. Plus, we'll get the Fed minutes. Thursday, we've got the US PMIs and another round of jobless claims. Some people are saying they are the most important numbers every week. Fed Speak, Jefferson, Bowman, Harker, Cook, Kashkari, Waller all follow the minutes. And Friday, Warner Brothers Discovery Report. This is Bloomberg.
the reception, the acceptance of pulsating has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of pulsating all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele is on vacation this week. Not to worry, we got Bailey Lipschultz here. He's from Bloomberg News, covers all the markets. He knows what's happening, so he'll be with us for the next couple of hours. Looking at the market here, a little bit of red on the screen here. The S&P off about 0.6%. The NASDAQ off about 1.1%. Coming up, we're going to check in with Dana Peterson, chief economist at the Conference Board. We had some economic data coming out from them, the U.S. leading economic index, so we'll break that down. We'll take a look at this big M&A trade, Capital One and Discover. We'll do that with the BI analyst who follows that stuff. RJ Gallo, senior portfolio manager at fixed income for Federated Hermes. He's going to join us as well. Give us his thoughts on these markets. The Fed's going to cut rates, right? So we'll check in with him. But first, let's kick things off with our good friend, Lisa Mateo.
You got it, Wall Street getting back to business after the long holiday weekend, but not so much good news. We have the NASDAQ, it's down about 1% right now. S&P 500 down about more than 0.5%. The Dow is little changed right now. The 2-year yield is lower at 4.58%. The 10-year yield lower as well as 4.25%, and the 30-year at 4.43%. Let's talk currencies. We have the dollar down. The dollar is lower. The Japanese yen, euro, British pound is stronger. Bitcoin at 52,031. And on the commodities front, we have NYMEX crude, $79 a barrel. Brent crude, $83 a barrel. This week, investors focusing tomorrow's release of minutes from the Fed's January meeting. This week, we'll also see mortgage applications, initial jobless claims for last week, and also read on home sales for January. That is your Bloomberg Business Flash. Paul and Bailey.
All right, Lisa Mateo, thank you so much. We appreciate that. Bailey Lipschultz, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio, and that's where you'll find it. Bailey, thanks for sitting in today. Appreciate it.
Hanging out, bringing the markets down, unfortunately.
Yeah, what are you looking at today?
What are you going to do?
I mean, I guess we're just waiting. We got some economic data. We've got some earnings coming out.
NVIDIA later this week, that's a big deal. So kind of wait and see. But maybe people are sneaking out for long weekends?
Yeah, I don't know.
President's Day?
I mean, Alex, yeah, she bugged out for the week. So good for her. We'll see her next week. Market Drivers is brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. Let's check in with Norma Linda. She covers all the markets for Bloomberg News. She joins us here in our studio. Nora, what are you looking at here?
Let's take a look at Walmart. We've got those shares jumping as much as 6.3% for the biggest gain since 2022. And this is reaching an all-time high for that stock. And this all comes after Walmart topped earnings expectations as consumers could just not stop shopping. Now, on top of that, we did have Walmart saying that it agreed to buy smart TV maker Vizio for about $2.3 billion. And this should really help out with the advertising business. Walmart has this advertising business called Walmart Connect, and it should help Walmart and its advertisers engage more with customers. So really good news here on this front. The company did deliver a softer than expected guidance for the current fiscal year, but all eyes are really on that report, and investors are happy.
Are you a Walmart shopper, Nora?
See, I used to be back in Virginia. We barely have any here in New York City. Where are they?
Well, you got to move to the suburbs.
I know. That's the key. That's the key.
So, I mean, this is the advertising business. You know, we saw initially with Amazon how they built, such a big advertising business on the backs of their huge traffic to Amazon.com. Walmart doing something similar here. And it just kind of goes to show. It used to be Facebook, Google were the two big digital plays. Now you've got a third candidate in Amazon, and maybe even now a growing fourth.
Right.
Big player in digital.
Also,
so
worth calling out Roku down more than 6% after that news, trading at the lowest level since early November. So competition fears in the consumer TV space or smart TV space. But Nora, you're also paying attention to Discover Financial.
Yes.
Big deal with Capital One.
I mean, we love deals here, don't we?
Sure.
This deal between Discover Financial Services and Capital One will actually be the biggest merger deal globally this year. As we know, everyone loves these deals, and this will create the largest U.S. credit card company by loan volume, surpassing J.P. Morgan Chase and Citigroup. And this is a $35 billion all-stock deal. And in the past, we've known that Capital One has had to rely on Visa or MasterCard to issue its credit cards, but this deal will quite literally cut out the middlemen. And so we have...
Discover has its own network, right?
Yes.
Okay.
So we'll be actually having its credit card will now go through through this merger and everything. It'll kind of cut out those middlemen that we were talking about. And so we were seeing shares of Capital One pairing a bit of their decline. They were earlier down as much as 5.5%, but are still lower by about 2% this morning.
I got a bunch of cards in my wallet. Neither are Capital One or Discover.
I just got an American Express Cashback Blue Preferred.
Oh, okay.
6% back on groceries. That's where I spend all my money these days.
Right.
So
okay.
boost
Very good.
returns
All right,
there.
we're talking credit cards here. Everybody's got a strategy.
They do. Are you a big points guy? Do you have you bundle? No.
No. I mean, I should be, but I'm not. My daughter, she's all over the points. So I think that's smart. That's the way to do it.
Hey, man, especially if you're able to kind of balance everything. You get points cash back. You get the boosted miles. Get the Amex
I'm
Platinum.
still working
and
on
hang
it.
out in nice airport lounges.
All right.
All the perks here.
Home Depot. What's happening there? People
Yes.
still shopping there?
Let's wrap things up with Home Depot. Now, this stock is in the red here, slumping as much as more than 2%. It reported a decline in comparable sales for the 5th quarter in a row. Now, we all know that this is all in the midst of high mortgage rates and a slowdown in construction, but as we did see comparable sales fall 3.5%, this was better than the 3.6% decline that analysts were expecting. But I mean, it's not good news to hear this for the 5th quarter consecutively. And many expect that the housing market will pick up ever so slightly this year, but the story is very much so macro-driven as it pertains to Home Depot right now. So until rates do come down and we do see consumers more comfortable with doing those home makeovers and moving, it seems as though Home Depot is having a bit of a struggle here.
I am not one of those people. John Tucker's like a home remodeler.
I know.
Handyman, he swings a hammer every once in a while. Not me so much. But you're now a homeowner.
I'm a homeowner.
I was gonna
so
ask.
now I go to Home Depot far too often. It's closer than Lowe's. So I was kind of torn between the two, but Lowe's is for me is so far out of the way that you got to go with more.
Isn't one for the more the contractor?
The pros versus the contractors.
Yeah, how does that
Yeah, which
play?
one?
I don't know. Beats me. I'm neither. So.
I thought it was I thought Lowe's was the one that made a lot of money off of like the Lowe's Pro members or the people who go there and buy pallets of everything.
I believe you.
I get, but I have people for that. So talk to me, Bailey. Are we going to have any IPOs this year? How's it looking so far?
We're firming up. I mean, today, notwithstanding, markets well off the October bottom. A lot of optimism. Really, the expectation when I talk to bankers, investors, even these private companies, something's got to give. A lot of these companies need cash. It's kind of a balance between if you can raise money in the private markets. If you're an AI company, there's no real need to go public. Okay. But if you're a Reddit of the world, Stripe, Turo, those are the companies that people are expecting to want to go public right now.
All right, very good. Nora, thank you so much for joining us. Nora Melinda, she covers all the markets for us, giving us an update here. Again, a little bit of red on screen here. We thank Nora for her comments here. Let's break it down. We got some economic data coming out. It's a little light today. We got more coming up later this week, but the leading index came out negative 0.4%. The consensus was negative 0.3%, so a little bit weaker there. Let's break it down. We had a negative revision as well to last month. Dana Peterson, Chief Economist at the Conference Board. So Dana, talk to us about this leading index data point that came out today. What is it, and what does it tell you?
Sure, absolutely. Well, it was down again. It's been negative for more months than I can count over the last 2 years. But the good news is that when we look at the 6-month average growth rate, it's no longer signaling recession, but it's still quite negative.
And how does this play into kind of the feeling around the economy and what this can mean for market watchers, for people kind of trying to guess what the Fed will or won't do, just given kind of some of the economic data we continue to be seeing?
Well, the thing is that it does signal that the U.S. economy probably is going to slow, probably over the second and third quarter, maybe even starting now in the first quarter. We did get that pretty weak retail sales data. But the thing is that the labor market is still pumping out jobs, wages are rising, so that could continue to support the consumer for some time. But I think that, we are going to see slower economy, but that also means slower inflation. So I think all these pieces give the Fed cause to start looking at interest rate cuts probably around the middle of the year.
So, I mean, again, I'm looking at just this over time, and the leading index has kind of been, negative here since kind of, March of 2022. I mean, how predictive is this index for the overall economy?
Usually the leading index does a really great job in terms of portending recessions. And that's because it captures a number of factors, certainly manufacturing activity, hours worked, which is often linked to manufacturing activity, financial market indicators and credit conditions, and certainly expectations among businesses and consumers. And so all those things, it's done a very good job of pretending recession. This time around, I think it was a little challenge because we had a surge in services activity, and also labor shortages meant that a lot of companies didn't let people go. And those are things that aren't really captured in the leading economic index. So maybe that's why it's been signaling for recession for a long time, but we haven't actually had one.
All right, Dana, thanks so much for joining us. Appreciate you hopping on, breaking down this data point. Dana Peterson, Chief Economist for the Conference Board. And again, the leading economic indicator came in a little bit weaker than expected this morning. It's kind of been, again, negative really since for many quarters now. So the question is, what does that mean for the economy? Looking at Bailey, today was a pretty interesting day in the. We got a nice big M&A trade, Capital One buying Discover for $35 billion. So it looks like the M&A market's heating up a little bit. We had a senior M&A banker from Citigroup on surveillance earlier today. She's been in the market for a long time. She was saying that they're seeing, particularly if interest rates do come down, they expect to see a pickup in deal activity in the M&A space.
No, and I think that's been the case when I talk to bankers who focus on IPOs. Are obviously kind of this dual track notion, whether you're buying private companies or public companies, the thing is trying to be, at least in the conversations I've had, trying to be kind of nimble with deals. So when you look at how Discover's been trading, you look at their issues on kind of a longer term basis. Right now it's trading at $123, which is notably higher than it was at the market's bottom. It's still below the peak from back in August of 2021. So you're trying to see kind of all these companies, a lot of these companies have dry powder and capital and ability to make some of these acquisitions. So it does seem like we're seeing more. And one thing that I pay attention to a lot is healthcare, biotech. We're seeing a lot of these companies trying to diversify their platforms.
So just, again, in addition to the Capital One $35 billion offer for Discovery, Truist Financial, which is a regional bank selling its insurance brokerage business in a deal valuing the asset of $15.5 billion, and Walmart agreeing to acquire smart TV maker Vizio Holdings for about $2.3 billion. So these take the value of deals, this is according to Bloomberg News, announced globally this year to roughly $425 billion. That's according to data compiled by Bloomberg. And that's a figure that's up 55% year on year to this point in 2023. So when I think of M&A, I think it's, when you get to the board level and the C-suite level, they have to have confidence in their business, confidence in the economy to make that type of investment. That's what it tells me when I see M&A activity pick up. So maybe we're seeing a little bit of that, again, given some of the rhetoric from the Fed, that maybe we've seen peak rates.
Yeah, and the interesting thing is when you look at some of these deals, right? You've got Walmart buying Vizio, which is a small deal, all things considered, for Walmart, but expanding in a different direction. You have this big deal, as you mentioned, between Capital One and Discover Financial. So you have kind of across the board in terms of deal activity so far in the first, call it, 2 months of the year, where you're seeing some of these smaller bolt-on deals, but also kind of really landscape-changing deals, again, kind of leaning on to Capital One's decision to buy Discover Financial. But as you mentioned, we've had a dearth of deals in 2022 and 2023. So globally, it does seem like the whole kind of rhetoric is something's got to give, and that's why you're seeing an increase in deal activity.
And it's interesting. We've seen them across different industries, and Bloomberg News reporting here since the start of January. Chip design company Synopsys has agreed to buy software developer Ansys. That's $34 billion in cash and stock. In the natural resources space, Diamondback Energy has struck a $26 billion deal to acquire fellow Permian Basin driller Endeavor Energy. And in financial services, investment giant BlackRock announced a $12.5 billion purchase of global infrastructure partners. So you're seeing it across industries here. And in my space, the media industry, there's expectation that we may see a deal there. Paramount Global, the former Viacom, the combination of Viacom and CBS, expectations there that the company is willing to sell, and now the chatter in the media space is just who buys it. A kind of a strategic player like a Warner Brothers Discovery, or maybe a private equity player comes in there. So there's certainly plenty of capital on the sidelines, whether it's private equity, private debt. There's a ton out there just looking for a home, I guess.
And all about the recycling of cash. With that in mind, you have a number of these portfolio companies for private equity that want to exit via IPO, because then they can now liquidate those assets, make a nice return on that, and then turn around and go out and buy something. You look at a Bloomberg scoop from 20 minutes ago about Advent and Blackstone said to circle a $20 billion Sanofi arm. So this is, again, another big deal or potential deal in terms of some of the world's largest buyout firms going after a consumer health division of Sanofi. We've seen a lot of companies, whether it's spinoffs, you're looking at GE Healthcare GE continuing to split into 3 companies, or just broader breakups of some of these companies that grew through big deals and are now trying to right-size and attract investors that way.
All right, so that's the M&A space. Again, another, I think, element of a healthy market, or a market where investors see some optimism, is in the new issue market. And that's also been a quiet market. That's a beat you cover. Are we going to have any marquee names?
Reddit's the one everyone's watching. Reddit is seen really as the next candidate to flip public. It's been we've reported, as have a number of outlets, that we could see their filing in the coming week or so, that they could look to go public in March. The big question is what kind of valuation they draw. This is a company that, in terms of comps, you're looking at Pinterest and Snapchat, who haven't really performed well from the 2021 top. I was talking to a company who runs kind of a platform that monitors share trades of private companies, and they've seen a lot of this is just companies getting more comfortable with valuation resets and kind of throwing in the towel that 2021 was more of an anomaly as opposed to what they're really worth.
So is Reddit going to be a down round vis-a-vis? Yeah. It will be.
It has to be. I mean, you look at Instacart. You look at Instacart. They raised cash, I want to say, at $39 billion.
Yep.
Right now they're trading around 8. So you're looking at big sell-offs for some of these companies that raise cash. And really, when you talk to some of the CFOs, they just want to get public. They want to get an exit. They want to have liquid stock as opposed to being stuck private and trying to tap VCs for a top-up round at some valuation that maybe venture capitalists don't want to buy it at.
Right, exactly. And there clearly was, and to a certain extent still is, a stigma to doing down rounds, but there's been more than one of them. There's been enough of them that maybe that signals a little bit less so. If I'm a banker, I'm like, that's just this is the world we're in.
Exactly.
And so now don't worry about valuation as much as Do you want a liquidity event or not?
Well, and the thing that comes up when you talk to some of the companies, some of these CFOs, the big thing for them isn't necessarily the perception of a down round. It's the sense that, hey, if you were our last investor, we're sorry that you bought high. That happens in public markets. But if we go public, you can at least liquidate your position, or maybe we'll get back to where we were.
Yep, interesting. So we'll see that presumably with interest rates coming down at some point this year. Now it looks like maybe later rather than sooner this year. That'll bode well for markets broadly defined, bode well for the M&A space, as we heard earlier from that Citi banker, and maybe bode well for the new issue market. Right now, the S&P 500 is off 0.6%. The NASDAQ off 1.2%. The Russell off about 1.25% as well. Yields, 10-year Treasury, 4.25%. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Not the best start to the new trading week right now. The NASDAQ down more than 1%. We have the S&P 500 down more than 0.5%. The Dow right now down about 0.1%. The 2-year yield is lower at 4.58%. The 10-year lower as well as 4.25%. And the 30-year at 4.43%. For currencies, the dollar's weaker, Japanese yen, euro, British pound stronger, Bitcoin at 51,692. And on the commodities front, we have NYMEX crude, $78 a barrel, Brent crude, $82 a barrel, spot coal higher at $2,028 an ounce. And a pretty quiet day as far as economic data for today, but tomorrow things change. We have the release of minutes from the Fed's January meeting, and yes, we'll also be watching for earnings from NVIDIA after the bell tomorrow. That is your Bloomberg Business Flash. Paul and Bailey.
All right, Lisa Mateo, thank you so much. We appreciate that good stuff here. It is Bailey Lipschultz sitting in for Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio, and there you go. All right, nice M&A trade here in the financial space here today. We got Capital One Financial. They're acquiring Discover Financial on a $35 billion all-stock deal, so no need to go to the bond market. They're going to create the largest U.S. credit card company by loan volume, giving the combined entity a stronger foothold against some of the big Wall Street behemoths. Let's see what's behind the deal here and what the numbers show us. Ben Elliott, he's a consumer finance analyst for Bloomberg Intelligence, joins us via Zoom from Washington, D.C. All right, Ben, what's Capital One thinking here? Is this another one of these deals that's really driven by scale?
Yeah, so everything's driven by scale in the credit card business, Paul. And the big thought here from Capital One is that if they can acquire this sort of rare and valuable thing that Discover has, which is a discrete proprietary payments network, then they can sort of start to compete with Visa and MasterCard on a much bigger scale over time, and they're paying a premium for it.
Ben, is the timing at all a surprise, just given kind of the issues that Discover had towards the end of 2023?
So it leaves Capital One with a potential legal overhang. The legal issues are not settled yet at Discover. They've had a couple of new issues that are sort of outside of the scope of what they've been dealing with over the past couple of years. Discover's been talking about sort of a $500 million a year run rate of additional compliance expense. So that's sort of a burden that Capital One is going to have to take on with this acquisition. But I think it's probably pretty well understood, the scope of that, and I think it's probably priced into the deal.
All right, so give us a sense of the size of Visa, I guess the Visa network, the MasterCard network, and now this new combined network. Is it competitive to Visa and MasterCard, and I guess even Amex?
So historically, it's completely non-competitive. Okay. Visa and MasterCard together are about $10 trillion in domestic U.S. credit and debit card volume, and Discover is about $550 billion. Ooh. So it's always been this sort of the tiny, redheaded stepchild of the large payment networks. But if you add to that Capital One's hundreds of billions of dollars of credit card loans, and you sort of extrapolate future growth there, it has the potential to sort of compete more like an American Express, which is closer to $1.5 trillion.
Ben, I feel like we can't talk about deals without the threat of regulatory scrutiny. What does this bring, and what could the FTC raise any red flags about?
Yeah, so I'm obviously not a regulatory expert. Paul knows well that we have a great M&A analyst, Bloomberg Intelligence, Jen Rhee, and I'm sure you guys will ask her later. But overall, this deal, I think, will be relatively sort of non-offensive to regulators. Discover is historically not been very competitive with the large networks, so actually bringing sort of the power of Capital One to bear will make it more competitive with the large networks, which has the potential to give customers a real sort of fourth alternative. Whereas in the past, you really only had one option, right? You get a Discover card. It only has one sort of set of rewards. It's got a relatively low credit line versus some of the other offerings. It doesn't have sort of, high-end travel rewards offerings. So I think if Capital One can start to issue some of its sort of higher-end cards on the Discover network, that could be pro-competitive, and that might make the deal somewhat more attractive to regulators.
So I'm looking at MasterCard, the shares of MasterCard and Visa, each down maybe 2-3%. Do they really care here in terms of a response?
I think they're looking at this as sort of an interesting gambit. It's definitely it's a shot across the bow, Visa and MasterCard, but this is a huge, probably decades-long battle that Discover Network, backed by Capital One, will be fighting. They plan to keep the Discover branding in place for the most part and shift primarily debit card volume to Discover at first. So, even in the first, call it 3 years of this transaction, they're not really going to be issuing Capital One credit cards on the Discover network. And so that really puts off any concern for Visa and MasterCard, into the medium to long term.
Ben, in terms of kind of what these credit cards offer, Discover, from my understanding, mainly cashback. Capital One has a range of some of those rewards cards. How does that impact potentially acquiring new customers and new users for both companies, or I guess the folded-in company?
Yeah, so I think that will make it a challenge for Capital One to issue some of its sort of high fee, high reward cards on the Discover network, because historically the Discover network's only been used for a very limited cashback card with caps at, I think it's like $1,500 a quarter of cashback. So for your high spenders, people who are putting tens of thousands of dollars on a credit card, that's not a very attractive offering. So that means that the brand has not been sort of in their minds as a potential credit card they might acquire. So Capital One is going to have to do some relatively heavy lifting, and you see that in what is a very modest run rate synergy assumption in their sort of deal model, which only cuts back Discover's marketing costs about 10%. So Capital One is going to have to do some pretty heavy marketing, I think, to start to leverage that network on the credit card side.
American Express, what's the investment call there these days? Ben, what are investors thinking about Amex?
Amex is the super premium bastion of the highest spending, sort of most financially sound customers. So that is a sort of, it's sort of a recession-safe trade, if you will. So, when people are looking at the forward curve and they're seeing rate cuts, they're expecting a recession potentially, they look at the Amex spender and think that this person will last the longest and have the sort of lowest level of charge-offs through a potential recession. So that makes it very attractive. And additionally, Amex has a ton of momentum in acquiring millennial and Gen Z high-earning customers, which is the most valuable sort of wallet share that's out there, and Amex does it better than anyone else. So that also kind of makes them attractive to investors.
Hey, Ben, here at Bloomberg LP, we recently switched our corporate credit card from one vendor to another. Why did that happen? Was that simply price? Somebody came along and said, hey, Bloomberg will do it cheaper? Is that how that business goes?
Well, obviously, I have no insight into that particular deal, but that can be a number of things. That can be the sort of reward structure. That can be the cost structure. That could even just be simple sort of customer service and applicability of sort of technology on the corporate fulfillment side. So I don't really have any insight into what that particular move was.
It all works for me. It all goes to Redo, keeper of the whatever the card is. All right, Ben. So what is the big competitive overview of kind of consumer finance? Are we using more credit, more debit, more Venmo? What are kind of the big trends there?
Yeah, so there's been a huge growth in credit volume over the last couple of years, especially sort of in the post-pandemic period. There's been even more of a secular shift away from cash. As for the various sort of channels, right, credit is really attractive to higher end consumers, people with more discretionary income, because that offers the huge valuable reward potential. And then if you step down to debit cards, there's some cash back, but for the most part, not a lot of rewards there, but there's some convenience. And then sort of the lower tier kind of fintech payment systems, they're sort of targeted at sort of younger sort of Gen Z, lower spenders, and they are the people who are exploring things like buy now, pay later, which is sort of a way to give credit to people who don't really have a lot of credit history or substantial earnings history.
All right, Ben, thanks so much for that. Appreciate it. Ben Elliott, consumer finance analyst for Bloomberg Intelligence, is joining us via Zoom from Washington, D.C. And then there are those of us who walk around with a wad of cash, because that's how you play.
Who do you pay? Who do you pay in cash?
Very few people now. Very few people now, and it used to be. You walk into a bar in the Jersey Shore, you got to put a 50 down on the bar to make sure you're.
Let them know you have business.
Let them know you're serious.
Okay.
I'm not going to give them tap my phone. They throw me out. But no, you're right. You just don't use cash anymore.
No. I only use cash at halal carts in New York City and my dive bars that I can't say their names because otherwise people go to it, so we got to keep it secretive. But those are the only places I use cash.
I know, it's crazy. So, but I mean, now it's just, I'm thinking, you know, one of the greatest companies or technologies in that space was Square. They're the ones that revolutionized it. I think for the local retailer, I mean, because all you have to do is stick that thing on your phone, and then a local retailer immediately has the ability to kind of migrate to a more of an electronic payment.
That completely changed, especially here in New York City, where if you would go to a farmer's market before, you'd have to worry about, do I have enough cash? What if I want to buy more things? Just tap to pay. It's so much more simple, but...
So great company, Square, great ticker symbol, SQ. What do you do then? You change the name of your company.
Change to Block.
I mean,
We traded $65 down from a high of 281.
Yep, just crazy. Let's change our name. S&P 500 off 0.7%. The Nasdaq taking on chin off 1.5%. With our news in New York City, here's Michael Barr.
Paul Bailey, thank you very much. The U.S. has proposed a UN Security Council resolution calling for a temporary ceasefire and for Israel not to go ahead with a planned offensive on the southern Gazan city of Rafah. Bloomberg's news director for Europe, the Middle East, and Africa, Rosalind Matheson.
According to the draft that we've seen, the U.S. actually uses the word ceasefire, which is a word they've been highly reluctant to use for months during this conflict. They preferred to call for a pause in the fighting, and they've blocked some resolutions that have called for an immediate humanitarian ceasefire in Gaza. So it's certainly a shift in tone from the U.S., but it does reflect what we've been seeing from the U.S. in the recent weeks, including from the U.S. President Joe Biden himself, a real sense of frustration, exasperation with Israeli Prime Minister Benjamin Netanyahu. They've been talking on the phone quite regularly.
Bloomberg's Rosalind Matheson also says attacks in the Red Sea continue, deterring shippers from going through that area. Lawyers for WikiLeaks founder Julian Assange are back in court for another attempt to keep their client from being sent to the U.S. for leaking of sensitive American intelligence. Outside the High Court of London, protesters have gathered calling for Assange's release, including his wife Stella.
Julian is a political prisoner and his life is at risk. What happened to Navalny can happen to Julian.
Assange continues to be held in a UK prison where he has been since 2019. A Russian court upheld the detention of Wall Street Journal reporter Evan Gershkovich. The U.S. government deems Gershkovich to be wrongfully detained following recent remarks by President Vladimir Putin that he is open to a prisoner exchange for the journalist's release. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Red on the screen this Tuesday, the Nasdaq down more than 1%, the S&P 500 down more than 0.5%. The Dow right now is little change. The 2-year yield is lower at 4.57%, the 10-year at 4.24%, and the 30-year at 4.42%. We'll check in with gold. COMEX gold is at $2,038 an ounce. That's higher. Spot gold at $2,027 an ounce. Then over to oil, NYMEX crude $78 a barrel, Brent crude at $82 a barrel. As far as currencies, we have the dollar weaker, the Japanese yen, euro, British pound stronger, and Bitcoin at 51,545. That is your Bloomberg Business Flash. Paul and Bailey.
Hi, Lisa Mateo. Thank you so much. We appreciate that. Bailey Lipschultz sitting in for Alex Steele. Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube. Inner office mail envelope. You didn't know what that was?
No idea.
The inner office.
I graduated in high school in 2012. So,
I mean,
when was it phased out?
No, I guess when you got email, right? When you got email, you didn't need to send it.
No, we were still using it a little bit.
Were you?
After,
Wow. Crazy.
2005, maybe?
Exactly. Very good. All right. The cultural divide continues between Bailey and myself. RJ Gallo joins us. He's the senior portfolio manager of fixed income at Federated Hermes. RJ, it's been a tough couple of years for you fixed income guys. 2022 was just brutal. And thanks to November and December of last year, you had some positive gains, some pretty nice positive returns. This year, starting off in the red yet again. What's kind of your call here as you look ahead in your fixed income space?
Well, good morning. It has been a wild ride, but I think if you were to look in a fixed income 101 textbook, if you told a college student reading that textbook that inflation would rise to over 9% in short order, do you want to own bonds? Right. Yes or no? Then if you told them that inflation would fall from over 9% to a 3 handle, maybe even a 2 handle in short order, then your answer would be different. It's been a difficult time to be a fixed income portfolio manager, but I also think we've reestablished value in a market where yields have been suppressed for so long due to the subpar growth in the post-global financial crisis environment. The pandemic unleashed many forces. The most important one was a series of inflationary forces, and the bond market paid the price. I think that price is in the past. I think that the returns prospectively are much more attractive, vastly superior to what we saw in 2022. The fourth quarter of 23 was extraordinary, but I think we're expecting mid-single digit kind of total returns in a year that we face now as inflation is apt to settle. Its recent bubbling has been a little unwelcome, and the economy is doing relatively well. A recession doesn't seem to be in the offing, but we think that this environment for fixed income, given yields that have reset to much more attractive, real positive levels, still have a place for investors.
RJ, what do you like in a environment that I would say continues to be relatively warm from an economic data perspective?
Well, I can tell you how we're positioning our fixed income portfolios. I mean, generally speaking, the interest rate volatility that we just alluded to, we think the worst is behind us. We've been constructed with a neutral to a slightly long duration at various points in the last 6 months. That's an expectation of the fact that we think inflation will resume a downward march, and the Fed will ease monetary policy, lowering rates because high positive real rates are not normal. The Fed has admitted that they're restrictive in their current positioning, and that won't last. As inflation continues to march down towards 2%, the Fed will feel compelled to support lower real rates as well. They don't want to maintain a restrictive policy when inflation's cooperating. The economy has been strong. It's very true. In the fixed income space, I think a lot of money has been put to work chasing credit. Why? Because with a strong economy should support profits. We've been a little underweight credit. Number one, we had anticipated we'd have slower growth last year than we did, so that ended up being not helpful for our overall performance. At this point, though, we think the valuations have gotten very rich. So some slowdown in the economy we think is apt to produce opportunities where spreads might widen a little bit and relative value will be more compelling than what we're seeing now. So we are overweight higher grade products. So we're still overweight mortgages, for example, in our multi-sector funds, leaning long duration, as I mentioned, and then underweight IG, high yield, and commercial mortgage-backed securities where we think credit and valuation are not too compelling just yet.
You know, RJ, I would say up until, I don't know, a couple of weeks ago, people were certainly pricing in cuts, and it was just a question of whether it was March, and then the Fed took that off the table. Then it became, if you look at the WIRP function, maybe May, maybe June. Now, in the last week or so, I've actually heard, we had a guest come on and say, hey, you have to have a scenario where the next move is a move higher in rates. Does that seem reasonable to you in any case?
I can see why they would say that. I mean, so you remember we finished last year with this like torrid fixed income rally, and we were happy about it. You know, we were constructive on bonds. It was great to see some positive returns, which we thought we would get by the end of the year, and it really all happened in that fourth quarter. But the market overshot. The market had gotten to the point that some of the justifications I just mentioned for being constructive had been fast forwarded and baked into prices to a degree that wasn't sustainable by the data. Economic data is pretty clear. The economy's in pretty good shape. The labor market is still strong. Inflation's a lot lower than it was, but it's not low enough to justify 6 or 7 eases that had been priced into the market, say, by December of last year. We felt that data would come along to probably push back on the market a little bit more effectively than, say, Fed speak pushed back on the market. Ultimately, what we saw was that data has proven more powerful pushback than speeches from the FOMC. But the FOMC has made clear they aren't going to ease preemptively. They're only going to ease if the data continues to back up justification that inflation is declining and the Fed should be normalizing policy at a lower level. What is normal policy remains a key question, obviously. The Fed suggests 3 eases in this calendar year as the median dot in the summary of economic projections. They still have a long-run neutral Fed funds rate of 2.5%. I would argue the bond market, if you look at forward rates, thinks it's about 100 basis points higher than that, give or take. I would side with the bond market on that. That means that the bond market can rally some as the Fed eases and the economy slows, but absent a recession, I wouldn't be holding my breath for the 10-year to hit 3% anytime too soon. That's going to take a while.
RJ, you mentioned economic data mattering. We have FOMC minutes tomorrow and then initial jobless claims, PMI. What data points are you looking at to get a better read on what the Fed can do and will do next?
It's funny, the Fed looks at the totality of the data. I love that expression. But if you had to provide some insight on what you give greater attention to or greater weight, what you assign greater weight to, the inflation data is fundamentally important. The Fed would be very happy to see real economic data, data portraying an economy that is continuing to expand, accompanied by declining inflation. That's the soft landing. That's what they want. So I think the inflation data still is first and foremost the most important in the broader scope of data stream that's coming out. That said, if the economy looks to be re-accelerating, then the reason that becomes a concern, I think, for the bond market is that you would be more cautious about your expectations on inflation. Will inflation continue to decline if the economy, in fact, re-accelerates? That would be a real challenge for the market. That's the kind of data set that might feed expectations that maybe the Fed will tighten again. I actually think that's highly unlikely. I think a Fed funds rate of 5.25 to 5.50 is already clearly restrictive. You don't need to tighten again as much as keep it there longer. So keeping it there longer, if Paul, you mentioned the WIRP function before, that would translate into the WIRP function having to move. You'd have to keep pushing out further and further into the future your easing dates. So the Fed would react to data that portrays a stronger re-accelerating economy and or sticky inflation by just holding the fort. Stay at 5.25 to 5.50 longer, and then that will reprice markets, as we've already seen this year, as the market had to reprice to higher expected yields after the overshooting of last year.
All right, RJ, thanks so much for joining us yet again. We always appreciate getting your thoughts. RJ Gallo, Senior Portfolio Manager, Fixed Income, Federated Hermes, joining us via Zoom from Pittsburgh, PA, one of my favorite towns, great town there. And Federate, one of the big money managers in Pittsburgh. S&P 500 off 0.6%. The Dow's unchanged. The NASDAQ off 1.25%. We're going to have more coming up. This is Bloomberg. Good morning.
your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Home Depot, we'll start there. They reported a fifth consecutive quarterly decline in revenue. Drew Redding with Bloomberg Intelligence tells Bloomberg Surveillance that it's about the slowing demand for home renovations and consumers' ability to spend.
I do think that the consumer is under greater pressure, and at the same time, I think that the home improvement industry has some unique factors going on because they're so tied to what's happening in the housing market. And, you know, as we've seen over the last year and a half, housing is just frozen at this point, and transactions are completely depressed, and we think that keeps a lid in the near term on demand.
Now, Home Depot shares are up about 0.3%. Now, on the flip side, we have Walmart. Those shares are higher. They're up about 3% right now. And this is after earnings topped estimates last quarter. It also agreed to buy Vizio for about $2.3 billion. And sticking with retail, Macy's said it received 9 nominations to its board from Arkhouse Management, who's looking to buy the company. Right now, Macy's shares are down about 1%. Now, over to the financial sector, Barclays looking to return at least $12 billion to shareholders in the coming years. It plans to do that by cutting costs of the $2.5 billion by 2026. Bloomberg's Tom Metcalf says the UK lender also plans to boost its return on equity in a big way.
They're looking to get that return on equity up from 9% up to 12% by 2026. So, you know, the interesting thing for me is, you know, Barclays as we know it, big investment bank, UK retail bank, and also some card payments business, is the executives are trying to do this without, you know, massively changing that mix. Really what they're going to do to get to this point is effectively shrink in relative terms the importance of the investment bank to the group. And, you know, big question is how on earth can you go about boosting returns at a business you're actually going to be shrinking your capital allocation?
Now, shares are up about 9% in London. That's your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, quick check of these markets. S&P is off 0.5%. The Nasdaq's off 1.1%. Yields come in just slightly. Got the 10-year 4.25%. And I'm looking at Bitcoin here. It's off about 0.5%, 51,650 for the cryptocurrency on a fairly quiet trading day. Right now, with our news in New York City, with Michael Barr.
Paul, Bailey, Lisa, President Biden now says he'd be willing to talk with House Speaker Mike Johnson about stalled aid for Ukraine and Israel. More from Bloomberg's Jody Snyder in Washington.
The Senate did pass emergency funding after the Senate had tried to pass a border security bill with this funding. The House did not take up that border security bill and sort of said it was dead on arrival. And then the House didn't take up this recent funding bill before going on a 2-week vacation, before which they had voted to impeach the Homeland Security Secretary. So the White House is very frustrated with this.
Bloomberg's Jody Snyder in Washington. Supporters of the $95 billion package are saying the fall of the Ukrainian city of Avdiivka and opposition leader Alexei Navalny's death in a Russian prison are adding to the urgency. A woman with dual U.S. and Russian nationality has been detained in Russia and accused of treason for providing support to Ukraine's military. According to state media, the unnamed 33-year-old woman is from Los Angeles. A historic ruling overnight from the Alabama Supreme Court could impact the future of in vitro fertilization in the state. The court ruled frozen embryos qualify as people under its state law, and anyone who destroys them is left facing possible wrongful death lawsuits. For patients and doctors like Dr. Mamie McLean from Alabama Fertility, the ruling is incomplete and confusing.
We're concerned that this ruling has far-reaching consequences for what we feel is safe to freeze and safe to discard.
Dr. McLean says the ruling could block women from accessing IVF and making the process more expensive, or force some clinics to close altogether because of legal risks. WikiLeaks founder Julian Assange was a no-show for health reasons at his final appeal against extradition to the U.S. for publishing secret military and diplomatic files. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Paul, Bailey, Lisa.
All right, Michael Barr, thank you so much. We appreciate it. Bailey, this is really a story for Matt Miller. It goes to Rivian, the electric truck maker. It's lost its claim to be Tesla's most credible competitor long ago. Now, its ability to navigate an EV demand slowdown poses its biggest test yet. with even auto industry stalwarts such as Ford Motor Company dialing back their expansion plans. The top question for investors will be how an unprofitable, cash-burning startup can weather the storm. Markets will be seeking clarity when the Amazon.com-backed firm reports fourth quarter results on Wednesday. The day is past when you could be a story in the stock market where, hey, we're growing the top line. Just focus on the top line. It's been a couple of years now where the market's kind of pivoted and said, for a lot of companies, including Meta/Facebook, we need to see improved profitability, and that's certainly the case with these EV manufacturers.
And that's why you're seeing a company that went public right around the top back in November 2021, traded as high as $179, right now at 15.
Yep.
But one thing, Paul, you gotta keep in mind is this kind of fallout does come as Tesla struggles. So you have the Magnificent Seven rallying. Well, Tesla's down more than 20% year to date. When you go back to when Rivian went public, it's down some 40%, losing more than $410 billion in market value. So it's an issue for these startups, but it does continue to be an issue that's bubbling up for Ford, for these big automakers, just given kind of the costs you have to cut and the ability to actually make money on these EVs.
That's right. And so it kind of comes down, the big question has always been out there, but I think it's getting much larger in the last 6 months, which is overall demand for EVs. As Matt Miller is fond to point out, you got the early adapters, you got the, the people who wanted to look like they were going green and all that kind of stuff, and you've exhausted those buyers. Now you got to kind of get to the meat and potatoes of people out there. And do they want to pay a premium? No. Do they want better performance? Yes, in terms of charging and all that kind of stuff.
Morgan Stanley basically saying their math spits out that it costs over $64,000 just to make each car. So high price tags for people to maybe buy a car.
All right, Rivian Automotive, keep an eye on it. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in on some companies reporting earnings. We're going to check in on the restaurant business. Drew Redding, Bloomberg Intelligence, U.S. homebuilding analyst. He's going to join us to talk about Home Depot. HD is the ticker there. They reported some numbers. We'll break that down. Then Michael Halen, Bloomberg Intelligence, restaurant analyst. Give us a sense of how things are going in the restaurant business. Are people spending? Are they going out as much? Are they spending as much? And where are they going? What types of restaurants? We'll break that down here. But first, let's go to Lisa Mateo and get a Bloomberg Business Flash.
You got it. Right now we have the NASDAQ down nearly 1%, so not the best start to the Tuesday after the long holiday break. S&P 500 down about 0.5%. Down right now is little changed. Yields are lower. The 2-year yield at 4.57%, the 10-year yield at 4.25%, and the 30-year at 4.43%. As far as commodities, let's check in with NYMEX crude. It's about $78 a barrel. Brent crude is at about $82 a barrel. Spot gold at $2,027 an ounce. COMEX gold at $2,038 an ounce. Now, this week, investors are going to be focusing on tomorrow's release from the Fed's January meeting. Today, it's kind of quiet. This week, we'll also see mortgage applications, initial jobless claims for last week, and also read on home sales for January. That is your Bloomberg Business Flash. Paul and Bailey.
All right, Lisa Mateo, thank you so much. We appreciate it. Bailey Lipschultz sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. We're also in your dashboard. We got that Apple Auto Play and all
Apple
that.
CarPlay,
Apple
yeah,
CarPlay, Android Auto. So we're all over the place. Tom Keen's definitely into playing around with those apps there. So we appreciate all those good partners here as we do new distribution platforms for Bloomberg Radio. Let's go to Norma Linda. She covers all the markets for us. She checks in here. Give us a sense of what's happening out there in those markets. What names are you looking at, Nora?
Yeah, let's take a look back at Walmart. Those shares are jumping as much as 6.5% for the biggest gain since 2022 and reaching an all-time high in this intraday trading. The company beat expectations with shoppers swiping their credit cards like crazy. It saw same-store sales, which is a key metric for retailers, rising 4%, and the street was actually expecting a gain of 3.1%, so we are seeing expectations being beat there. And of course, we do know that they had better than expected holiday sales, but the company is still relatively cautious when it comes to consumer spending, so that they have been kind of pulling back and reducing their inventory, but ultimately we are seeing consumers really running towards some of these value names and buying cheaper products, and obviously Walmart is seeing the benefit of it.
Yeah, it does seem like big results. Stock's up more than 20% in the last 12 months.
Boy, I mean, Walmart, you mentioned all-time high. Holy cow. I mean, I looked at that chart. It's just amazing. I mean, it just keeps going and going and going. You think about, can they put any more stores out there? I mean,
I'd like one here in New York City.
So there's nothing here, right?
I mean, don't we have something in Queens? Or
I don't know.
Anyway, I gotta go to the suburbs.
All right, so I go to Rich Go just to see how our friends of the Walton family are doing. 17, 18, and 19. Jim Walton, Rob Walton, Alice Walton, all with about $75 billion in assets. So good for them.
Good for them.
Yeah. They also seemingly own like 15 professional sports teams, I feel like.
Yeah, and the big one was the Denver Broncos, the football one.
Broncos, right? And then even if you go adjacent to the Stan Kroenke owns the Colorado Avalanche, the Los Angeles Rams.
The Kroenkes? Is that relative?
Kroenke's married to one of them.
Is that right?
I think.
Okay.
All right, very good.
All right, what else you got for us, Nora?
Looking at Discover Financial Services, of course, this has been the talk of the day. Those shares are soaring as much as 14%. Now, that's the biggest advance since 2020 and its highest intraday level since 2022. Now, this is all kind of coming after that deal news. We had Discover and Capital One making the biggest merger deal globally for this year, and that will now create the largest U.S. credit card company by loan volume, and that's beating both Chase and Citigroup. And this was a $35 billion all-stock deal.
Yep.
I know we spoke a little bit about, we have Amex over here. We have a couple different card holders in terms of this roundtable here. But we are seeing its peers, MasterCard and Visa, slipping. And we do know that in the past, Capital One has really had to rely on Visa and MasterCard specifically to issue its credit cards. But now it'll kind of get that through Discover.
I just want to confirm also Stan Kroenke's wife, Ann Walton Kroenke, is the daughter of Bud Walton.
There you go. Okay, so it is
a
all
lot
in
of family.
Yes.
I did not know that.
Yeah,
So that's a
fun
new
fact.
news you can lose.
Yes, fun fact for this Tuesday.
Yeah, exactly. So going long, you never lose money on sports teams.
No.
I'd never see a write down on a sports team here in the U.S. at least.
And also, it seems like I remember taking the tour at AT&T Stadium in Dallas, Jerry World. He owns everything, and you can write so much off. So it's kind of an easy way to cover up money.
It's a good business. Good business stuff. It's not necessarily a great cash flow investment from time to time, but just in terms of asset value, long term, good stuff. HD, we're going to have Drew Redding, Bloomberg Intelligence analyst, coming up with the breakdown and the analysis of the Home Depot numbers. But what's the story here? They reported?
Yeah, I mean, so we were looking at Home Depot a bit earlier, and they did report. We do know that in the midst of it really being a high mortgage or interest rate environment, we are not seeing as many people remodeling, and so this company is seeing a fifth straight decline as it compares in terms of comparable sales. So we have really been looking at that company. Of course, you all know that I cover home builders, love Drew Reading, so I'm excited to hear from him. But it's just a really interesting space right now when you think about competitors, Lowe's, and after I looked. Following our conversation earlier, actually, apparently Lowe's is the one that...
That's what I said.
Yes, you did say that.
Pros.
So I wanted to come here and confirm that for you.
So Lowe's Pros. Okay. That's all right.
Lowe's Pros. Okay. Walton Kroenke's.
Yeah.
That's
two new.
Hope I'm not leading us astray. But I did want to quickly look at Super Microcomputer. That is a computer hardware and storage company. It's based in San Jose, California. And we really did see it rally last week, but it did see a halt after 9 days of gains. We are seeing the stock falling as short sellers are notching $1.2 billion in gains. I have my colleague Carmen Reinecke writing that story up. Really interesting here, and this is all in the mist. Surprisingly, after its price target was hiked to $1,300 from $700 at Rosenblatt. So,
is this a meme stock or is this real?
I mean, that's Bailey's territory. Let's see.
It gets caught up in the excitement. I mean, you have Super Microcomputer, which is a name that'll get the kind of chat rooms going, and then you do have the exposure to AI. I will say, the one thing that you got to keep in mind with some of these short seller stories, that's really if you shorted at the top. So you're still down, according to Carmen's story. Prior to today's sell-off, down more than $4.8 billion. If you've been short the stock, it's up 705% over the last 12 months.
I'm looking at the income statement here, the FA function, which gives you the income statement, balance sheets, all that kind of stuff. So they had revenue in, 2023 of $7 billion. 2024, looking to double that to like $14.5 billion, and then $20 billion next year. So let me see. Are they profitable? Are they profitable? Yeah, they're profitable. So I mean, and the free cash flow negative this year, but turning free cash flow positive next year. So I don't know.
You look at some of the projected growth. I mean, NVIDIA we'll get tomorrow, but anything around these AI names, it's astonishing. I wasn't obviously around on Wall Street or covering the markets back in the dot-com bubble, but
I was.
Similar? Different?
This is so much different because, like I said, these guys have real company, they have real profits. I was taking concepts public at a $20 billion valuation. Yeah, we're going to do pets. They're going to do it all on .com, and that's all we needed. So, yeah, much different today. But still, those meme stocks were a crazy, pandemic kind of thing, and I guess it still lives to a certain degree. All right, Nora, thanks so much for joining us. Norma Linda, she covers all the equity markets for Bloomberg News. We appreciate getting some of her time here. We're talking about Home Depot. Company reported some numbers here. Let's bring in Drew Redding. Drew covers all the home building stocks, which have just been ripping really for the last couple of years because that's the only way to get a home is you got to build a new one. And he also covers all the companies that are around the home building industry, including HD. It's up about 0.6% here today. Drew, thanks so much for joining us here. Break down what you saw and heard from our good friends at Home Depot.
Sure. So the 3.5% decline in same-store sales was pretty much right in line with what was expected. You have to keep in mind, though, coming into the quarter, the bar was pretty low for Home Depot. They continue to face consumers who are pulling back in big-ticket discretionary categories, so think things like flooring, cabinets, countertops. Conversely, they're seeing relative strength in some of the smaller scale projects. So those big-ticket projects are being deferred. We do think eventually they get completed, but that might be more of a 2025 story. But coming into this quarter, the real debate was around how 2024 was going to shape up. So they offered guidance suggesting that same-store sales would fall about 1%. And given what we heard from a handful of their suppliers over the last couple of weeks, which were calling for a flat market, I think it caught people a little bit off guard, ourselves included. We do think that the first half is going to be comparatively weaker than the second half as rates start to pull back, and we think you could maybe get a little bit of a boost from the housing market.
Drew, this may be a dumb question, but when I look at some of the consumer data that we've been seeing, we are seeing rising 90-day credit card delinquencies. How do things like that, what does the normal spender at Home Depot look like? You're mentioning kind of a pullback on some of those bigger projects. What kind of demographic does Home Depot really see in terms of driving sales and kind of putting those numbers together?
Yeah, so about 80% of Home Depot's customers are current homeowners. They typically have higher incomes, so they are higher spenders, and they're a little bit more resilient of a customer. I think where we're seeing the relative weakness is in some of the low-end spending, which is kind of going away on the DIY side. But, you know, if we look big picture, what's happening in the home improvement market is we're seeing a reversion to more typical spending patterns. So if you think back to the pandemic, we had the share of PCE that went towards household durables was at an all-time record, and we've seen that moderate since really the first half of 2023. So we think that there's a bit more of a reversion that needs to take place through the remainder of this year, which is going to keep total industry sales muted. You know, but you talked about the consumer. You also have the consumer out there who's battling with the cumulative impact of massive inflation over the last couple of years. So, you know, while we look at that headline number, and we see that it's moderating, it's really the cumulative impact that's kind of pressuring spending in the category.
Hey, Drew, what do you think is a normalized top line growth rate for like a Home Depot? I'm looking, you know, pre-pandemic, it was kind of